the market's been enjoying the sunshine over the last few weeks, and I don't think that's going to last.
We're still reeling from the unevenness of both the reopening, the supply chain disruptions. An economy is still kind of moving beyond the pandemic.
I think the market probably does not move materially higher from here. I think 4,300 will likely continue to be a resistance.
We think it's probably going to be growth that surprises us on the downside.
We are going to come out of this COVID crisis with a K-shaped recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The week begins right now, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together with the brilliant Katie Lyons. Bramo taking the rest of this week off, TK.
That was
Futures
brilliant.
down 0.5% on the S&P. TK, a little bit later this morning, retail sales in America, some target earnings. Then later, it's the Fed minutes.
I'm not going to mince words. Target earnings will be interesting, but I'm not going to mince words, John. Do we put an equal weight on retail sales as we did on inflation and on the jobs report in the distant past? And my answer is yes, we do. It's the spirit of 70% of the American economy, and the nuances of it will be important.
It is a nominal read on retail sales, Tom. And
yes.
I think we have to strip out gas spending as well. Just a couple of things to think about when that number drops at 8:30 Eastern.
Yeah, it's nominal. It's really important. Nominal in the United States has a certain tinge to it. And John, nominal in the United Kingdom has a certain tinge to it.
Tom, double-digit inflation.
Yeah, it's here.
Oh, wow. And this Bank of England has got some work to do.
And then part of it, John, I've been spending the whole morning on this, folks, doing conversions with Will Kennedy and Javier Blas on how you talk about this stuff in English. And the answer, John, is the biggest fear here for all, including Prime Minister Truss, is the idea of the duration, the persistency of this double-digit inflation. The idea it's going to go up and come down, I'm not so sure.
Kaylee, all these central banks have got more work to do, including the Federal Reserve. We get the Fed minutes a little bit later. In the face of this equity market has rallied aggressively. I've got UBS saying, don't chase this. I've got Citi saying, sell into further strength. There is just a wall of doubt that this market keeps climbing over.
Yeah, because this market is now betting on a dovish pivot from the Federal Reserve that Federal Reserve officials themselves have said is not coming. So I wonder when we get the minutes today, even though they are backward looking and so much has changed since that July meeting in terms of inflation cooling down and some of the other data points we've gotten, including that jobs report, is this a Fed that underneath the surface is really that much more hawkish despite some of the dovish messaging maybe that was accidentally conveyed by Jerome Powell at the press conference? Does that have the power to shift the tone in this equity market that just keeps running? 3-day
winning streak on the S&P up by about 17.5% from the lows of this year. From New York this morning. Good morning. Here's the price action on the S&P. We're down about 5 or 0.6%. The data coming out a little bit later, as I say, 8:30 Eastern time. Katie's going to run you through the numbers and what to look for in just a moment. Nasdaq futures down 0.7%. Yields are higher on a 10-year in America by 6 basis points to 286.76. And I can tell you, Kaylee, yields are much, much higher in the gilt market in the UK. They are flying.
Especially at the short end. Up more than 20 basis points on the 2-year yield, and that gilt curve between 2s and 10s is at its most inverted since the year 2000. Massive, massive moves in the UK bond market. I wonder how much we'll get movement more in the Treasury market today when we get that economic data. But before we get there, we do have more earnings. You and Tom already mentioned it. Target will be crossing the wire around 6:30 a.m. Eastern. And remember, like Walmart, Target has also lowered its own bar. Twice now it has lowered its guidance, talking about margin pressure due to inflation and consumers pivoting more towards spending on oil and gas. Yet Walmart was able to jump over that lower bar. It says its earnings aren't going to be down as much as they previously stated. So to what extent does that read through to Target, as it's down 22% on a year-to-date basis? Of course, one of the things Walmart talked about yesterday was because gas prices have moved lower, consumers have been able to reroute their spending toward more discretionary items. And to what extent will that be borne out in retail sales data at 8:30 a.m. Eastern time? What we're looking for on the headline is up just 0.1% month on month. Ex-auto and gas, though, up 0.4%. So how much do lower prices at the pump impact the behavior of the American consumer? That is the backbone of the U.S. economy. And of course, the Federal Reserve is going to look at this data. It will inform its conversations at Jackson Hole next week, and of course, the September meeting. And we may get more insight into what exactly the Fed was thinking about the move in September when the minutes come at 2 p.m. Eastern time. Yes, a lot has changed since that July meeting. But when they hiked 75 basis points, were they thinking they need to do it again? And does the hawkish narrative, their resolve to fight inflation, kind of push back on the idea that the market has now, which is a dovish pivot, John?
Kelly, thank you. Never mind the Fed minutes. I think we're all looking ahead to Chairman Powell at Jackson Hole, Wyoming, for some real guidance into the September Fed meeting. We've seen this movie a few times this week. Futures negative, and then we squeeze out a day of gains. This morning again, futures negative, 5/6% Joining us now is Marvin Lowe, Senior Global Macro Strategist at State Street. Marvin, would you chase this rally?
No. I think we were talking about it before the show began. A lot has been priced in. I wouldn't chase it at this point. I think a lot of good news and a lot of soft landing has been effectively reflected in kind of where valuations have gone over the last 6 weeks or so.
But Marvin, part of that is the idea that corporations adapt, whether it's use of cash, it's the dynamics of capital expenditures, and particularly the mix of revenue as well. Are you suggesting we pause here or pull back because corporations are done with wiggle room?
Yeah, I mean, I think a pause is probably a better way of looking at it from my perspective. Companies have a lot of flexibility. Companies have a lot of power within that balance sheet. And we have to remember that an S&P company is not necessarily the same as a general business within the United States. You've also got the relative aspects of the U.S. economy relative to the rest of the world. But in terms of valuations and what you're buying in terms of a forward perspective, there's a lot priced in. And there really is a lot of expectations that the market feels it knows what the path of the Fed is going to be over the course of the next 3 to 6 months, when it stops and when it starts to cut. And I think that is potentially a concern for me, in that it's still somewhat unclear because this inflation story is still evolving.
Yeah, well, Marvin, it strikes me that a lot of this narrative shifting toward a dovish Fed pivot has coincided with an earnings season that by and large also has been a lot better than expected. You're seeing surprises on both the top and bottom line consistently. And I wonder how much of this actually is fundamental and not too much optimism being priced in now, but too much pessimism being priced in before.
Yeah, I'm in the camp that we had too much pessimism going into the second quarter reporting season. Almost by definition, when you have inflation that's too high, you've got companies that have pricing power. They're able to increase prices, which ultimately keeps that inflation number high and keeps that narrative going out there. It's really once we get to a much more significant slowing in the economy that the companies start to reevaluate what their business models look like over the course of the next 12 months or so. And to me, it's the third quarter, which obviously historically has been one of the more volatile periods of the equity market, because we start really thinking about what the next year looks like.
Marvin, every day I put out the research, and just a couple of quotes from each bank. And I've put out the research from the likes of UBS and Citi in the last 12 hours or so. UBS saying don't chase the rally. Citi saying maybe sell into the strength. And here's the pushback, Marvin. Let me share it with you. Market leaders explaining to their clients why they missed the trade. Translation, we missed the bottom. We'd like to join the party, albeit a bit lower. Marvin, you see there the doubt, the skepticism that people have. Once you get about 18% into the move off the bottom, it feels like the spring of 2020 again, where people kept coming on programs like this and saying, we haven't seen the lows, we're going to retest the lows, we're going to retest the lows, and then the market's another 20% down the road. Marvin, why is this not spring 2020?
First off, you clearly have the monetary authorities doing the exact opposite of what they were doing at that point. So you had a very supportive market for financial assets back in 2020. The uncertainty that we have now is very different than the uncertainty that we had kind of back in 2020 also, where it's not a function of science kind of driving this. It's really just the economic cycle. And for the most part, while the central banks have moved in the direction that they've wanted, they really haven't gotten any of the end results that they want, which is a demonstrably and stably lower inflation environment and a jobs market that has some of the froth that's taken off of it. And that's not just in the U.S., it's global. So you've got this global push moving to a tightening perspective, which really will continue to move forward, as we've seen with some of the recent central banks that continue to hike at least a 50 basis point kind of cadence.
And somehow financial conditions keep easing in the face of all of that. Marvin, awesome to catch up. Marvin Lowe there. TK, I think that sums up the current debate for a lot of people.
It's a huge debate, John, and it's a nuance, and I would suggest we're starting to see a give and take, a back and forth of maybe the Uber bears reining it in a little bit, and the Uber bulls saying, well, that was nice, now what? But to me, it's just about uncertainty, and part of that's going to be solved with retail sales this morning at 8:30. John, we're all data dependent. I mean, Elon Musk is data dependent. He's got to look at Man U and say, does he buy at the bottom or does he buy later on?
Hey, Tom, wouldn't it be nice to be able to be joking about buying a football club in the Premiership, and then the stock market reacts to it because it's not sure whether you're serious or not?
Well,
wouldn't
John,
it be nice to be that rich?
John, I'm so large that after my third beverage of my choice tonight, maybe I'll put out a tweet. Mr. Levy, I need the tots.
TK's buying Tottenham. Tottenham just don't know about it yet. Man United in the pre-market up by more than 3%. Katie, I'll read the tweets. And also, I'm buying Manchester United, you're welcome. Elon Musk about 10 hours ago. Someone replied, are you serious? No. This is a long-running joke on Twitter. I'm not buying any sports teams. He goes on to say, although if it were any team, it would be Man U. They were my favourite team as a kid. There's only one man that can do this and then get that kind of reaction. It's just ridiculous sometimes.
That's the thing, is even if you're joking, he is well aware of his power to move a market in a massive way. And he is well aware that he has a cult following in some sense among traders who might actually take him seriously and make moves off what he said. My thing, John, is he's gotten in trouble for this before. What happened to his Twitter sitter? Is anyone still checking the tweets he sends out?
I have no idea whether that tweet got a check. I'll say this, though. I think it complicates the matter when it's a public company, Tom.
Yeah,
it's not a private one.
We need to be clear
company.
here. It's not like the Boston Red Sox. The Manchester United's a publicly traded company.
And we've got a move this morning of a little more than 3%. We'll pick up on that a little bit later. Tom, we also need to talk about Congresswoman Cheney as well. We'll head down to D.C. in just a moment. Coming up in the next hour, we'll catch up with Gagi Chowdhury of BlackRock, what she thinks is happening with the inflation backdrop and what she thinks you should do in this market. Yields are higher by 6 basis points on a 10-year, 286.94. Futures are down 0.6% from New York. For our audience worldwide, Bramo away, Kaylee in with Tom Keene. I'm Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Ukraine's President Volodymyr Zelensky has warned civilians to stay away from military facilities occupied by Russian forces. That followed explosions at a Russian ammo dump in Crimea. An advisor to Zelensky has said the blast marked the beginning of a series of attacks. Last week, explosions at a Russian airbase in Crimea destroyed fighter jets. Here in the UK, inflation jumped more than expected last month to the highest level in 40 years. The consumer price index rose 10.1% in July from a year ago, following a 9.4% gain in June. That will put pressure on the British government and the Bank of England to take action. Germany will struggle to have enough natural gas to get through the winter. That is according to the country's energy regulator, which says Germany will have enough gas for less than 3 months if Russia cuts off supplies completely. The country is racing to fill its winter stockpiles after Russia drastically reduced flows on the key Nord Stream pipeline. In Wyoming, Republican Congresswoman Liz Cheney has called on Americans to prevent Donald Trump from winning the White House again. Cheney suffered a crushing defeat to a primary challenger backed by the former president. She had become an outcast in her own party for her strong anti-Trump stance. The world's largest sovereign wealth fund has lost $174 billion in the first half of the year. That is more than a 14% loss for the Norwegian fund. Interest rate hikes, inflation and Russia's invasion of Ukraine led to market volatility. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I'm about to sign the Inflation Reduction Act into law, one of the most significant laws in our history. Let me say from the start, with this law, the American people won and the special interests lost.
We'll pick up on that in just a moment. That was the President of the United States from New York City this morning. Good morning with Tom Keene and Katie Lyons. I'm Jonathan Ferro. Lisa back with us next week. Futures down 0.6% on the S&P 500. On the Nasdaq down about 0.7%. A little bit later this morning, about 12 minutes from now, we'll get some earnings from Target. Then ahead from there, in about 2 hours after that, we'll get some retail sales numbers out of America. Then on to Fed minutes a little bit later. Tom, we've got to talk about the politics of Wyoming. The Republican Representative Liz Cheney losing her GOP primary in a way we anticipated, Tom. She's now going to front a new organisation. This from Politico. What she lost versus what she gained. Cheney lost her seat but gained something else. She is now the undisputed leader of the so-called Trump opposition.
I like the organization. I don't know what that means. Maybe it's pretty opaque. I think there's two great mysteries to Jackson Hole. One is John Farrell going to wear Lucchese or Tony Lama boots? And the other is when we attend Jackson Hole next week. And the other is exactly what is Liz Cheney's Wyoming? Anne-Marie Horton joins us here, our Bloomberg Washington correspondent. And Anne-Marie, I thought the Washington Post this morning, with tongue planted firmly in cheek, had Karen Heller talking about the fabulously wealthy of Wyoming. We all have our stereotypes. What did Liz Cheney lose last night in the fabulously wealthy Wyoming? The money's mind-boggling.
Well, she lost her seat, right? The seat her father also held in the 70s, one she had. This is their lone House seat, right? So she is not going to be coming back to Washington in that capacity, but as Jonathan said, she's going to be. And by the way, she still has about $7 million left over of campaign finances.
Okay. Well, so do you.
That's potentially potentially the money she's going to be using to launch this new party.
But you nailed it.
Organization.
Her Wyoming is not her father's Wyoming. What did she actually lose last night? To me, it's an exceptionally affluent state. Am I right on that?
Yeah, it is an affluent state, but as we talked about yesterday, Tom, and even though you had some Democrats switching their party lines with their registration to vote in this primary so they can back her because of her staunch defiance against Donald Trump and her criticism of the former president. You had people switching over. There were actual Democrats in some of the liberal parts, which are fair and few between, to vote for her in this primary. But this is a state that voted 70%. That is how much President Donald Trump picked up in the 2020 election, 70% of the state.
Yeah.
So now you have him backing Harriet Hageman. So it was very, very obvious. This was all but pretty much set in stone that she was going to lose this primary because this is a state that is staunch Republican and they also are staunch Trump supporters.
Anne-Marie, why is Alaska different? Obviously, this is in part a repercussion from Liz Cheney voting to impeach President Trump after January 6th. So did Lisa Murkowski, and yet she's advancing to the general. And I just wonder what that difference is and why her punishment on the part of voters hasn't been as severe.
I think there's two reasons why. One is that it's very obvious that former President Trump really took aim at Liz Cheney. That is where all of his firepower was coming towards, and that is where he really, really wanted to make sure that she was ousted. We also talked about the fact that this is heavily Trump country, right? And also, Liz Cheney did something different than we saw from Senator Murkowski, which is Liz Cheney right now is the leading Republican on the select committee investigating the president and the insurrection of January 6th. But also in Alaska, you have a different kind of ballot. So even though Senator Murkowski is going through, you're also going to have the Trump backer, Kelly Tshibaka, also going through, because what they have is a ranking system. So if your first candidate choice gets knocked out in the general election, your vote goes to the second or third of your ranking choice. So it's a little bit different in terms of logistics, but I also think with Liz Cheney, it was definitely more personal.
We all need to hear these numbers. David Gura shared this out on Twitter. It was a University of Wyoming poll that found of the likely voters who support Ms. Hageman, only 16% believe that the 2020 presidential election was legitimate, compared to 94% of Ms. Cheney's supporters. Anne-Marie, how is that one issue going to shape the midterms and potentially the next election?
Well, you're seeing it play out now, right? As you have the former president under investigation for a number of issues. Right now, of course, all the focus, especially tomorrow, we'll have this hearing from a judge in Florida about whether or not they're going to release this affidavit in terms of the investigation of Mar-a-Lago. all of this goes back to these unfounded claims from the former president saying the 2020 election was not stolen. And how this shapes the midterms is some Republicans are really going to lean in that, while Democrats are going to say, as Liz Cheney was saying in her concession speech last night, that this is the fight for freedom about democracy of the United States. It's also likely going to be one of the hooks that the former president uses if he is going to make his bid for 2024, which many do expect. That 2022, in his words, was a sham, so he wants to come back.
MH, I've got to squeeze this in, just on policy. We played that clip of the president saying this was a win over special interests. I was just thinking of Senator Sinema, and I was just sitting there thinking, really, when I watched him say that yesterday, Anne-Marie, was that really a win over special interests?
It's the first thing I thought, too, because obviously you had a provision to close the carried loophole tax, which makes sure that at a lower rate you have venture capitalists and hedge fund managers taxed much lower than they would on their income that we all pay normal taxes on. So while there's some good things in there, the president is going to tout for seniors and climate provisions, there is still the carried interest loophole for the most wealthy in this country. So it was a little bit ironic that the president would say that this was closing the gap on special interest.
It was a strange thing to lead with. Let's just put it that way. Anne-Marie, thank you. AMH down in D.C. One thing we can all agree on, Tom, it was a win for this White House. Signing that bill, taking that pen and handing it over to Senator Manchin, standing alongside him.
It's a win, and in traditional politics of another time and place, John, I guess you drive that forward with a lot of careful bow tie analysis. I'm not sure it works this time. But what's important here is Mr. Biden needs a series of wins, and maybe he's getting them in a clumsy way as we get to this midterm. I haven't seen any writings yet that it really tilts the change, but he's tightened things up. There's no question.
He's getting them slowly, Tom.
Yeah.
And gas is a part of that story, too. We'll discuss that a little bit later. Are we going to talk about the analysis of cowboy boots? Two brands that you named that I've never heard of.
Well, John, you know, you gotta. There's some nuances here. I mean, Tony Lama's got the two tones. You can get the custom boots, though, John.
That means nothing to me.
I see you more. You know, I can see. You know, Bezos has got like 4 million acres somewhere.
Do the Gucci lace-ups work, Tom?
No, the Gucci. No,
Tom wants to go south of 59th Street to Soho and go shopping.
Tom's wearing Prada right now. Seriously,
John,
people think I'm joking. He is.
John, you want the Lucchese low heels like I wear in the wonderful Don Imus wears.
I've got no idea what they are.
You don't trip over your guitar cable with low heels versus high heels.
There you go.
There's your pro tip.
Okay, we've settled that one. Thanks, Tom. This is Bloomberg. We got a few things to get through this morning. Target earnings coming up any moment from now. Then after that, retail sales in about 2 hours in America. Going into all of that, futures negative 0.6% on the S&P 500, on the Nasdaq 100, down about 0.8%. That's the equity story for futures on the Nasdaq and the S&P. Here's the story for Target. What a miss. EPS in at 39 cents. The estimate 72. We know these companies have got a monster inventory problem. We know that, and this stock is down by more than 4%, make it 9% now. Kaylee, they've got a massive inventory problem. Yeah. We know that, and clearly profit is taking it on the chin as they work through those issues.
Yeah. And the CEO himself said it in the statement. Inventory rightsizing put significant pressure on the company's near-term profitability. The thing, John, is that Walmart said the same thing previously and yet was able to jump over the lowered bar. Target missing even the twice lowered bar, clearly having even larger inventory issues. It is all about the balance of products. As consumers pay more for food and gas and you have too much higher expense discretionary spending, that is higher margin for these companies. And clearly Target is just having much more difficulty navigating that.
Second quarter comp sales plus 2.6%, the estimate 2.84%. They still see the year revenue growth in the low to mid single digits. So at least we're not going to cut to the outlook right now, unlike back in May 18th. Do you remember May 18th, Tom, when they came out and had to drop that one and the stock dropped by about 25%? This stock's dropping this morning, not as severely, though, off the back of this big miss. And, Tom, we know they've got this massive inventory problem and it's going to take a long time to work through it.
Futures negative 26 on Standard & Poor's, went down to negative 30 here off this announcement. John, I give them great credit for clarity of press release and buried 6, 7, 8, 9 ideas down. Operating margin rate of 1.2% reflected gross margin pressure. Basically 98 cents, to be charitable, 98 cents in the dollar is vaporizing down to making a penny or two, John. It's a tough business right now.
What I'll be looking for today, Tom, is to see how resilient the stock price reaction to this news is, because this is news to no one. We've been talking about this for a long, long time, Tom, a number of months now. And to see the stock come back in the way it has in a pre-market, at least for now, it might change. It's now positive by 0.25% after initially dropping 4, 5, 6, 7, 8, 9 percentage points, Tom. We've snapped back. So let's see how well priced this story actually is, given we've been talking about it for quite a while.
And I'm going to give him some clarity. I'm going to give him some credit here, John. Here's a sentence. Additionally, fall season receipts in discretionary categories were reduced by more than $1.5 billion. I mean, I'm in Target like every 10 days or so, John. And, you know, I can see where in clothing they've been absolutely pounded, but you wonder how that's spread over. And they've got a digital breakout where digital is actually off a little bit as well.
I'll bring you the company commentary. While the company is planning cautiously for the remainder of the year, current trends support the company's prior guidance for full-year revenue growth. Maybe, Tom, you can take just like a grain of confidence from that. It's been hard to trust the guidance from these companies over the last few months.
CFOs listening to us globally, can you just write a press release like Target where it's in English? While the company is planning cautiously for the remainder of the year. I mean, John, it really says it all.
You've got to be humble, Tom. You've got to be nimble. And we know that Target was basically preparing the company for the demand backdrop that existed a year or so ago. And we're in a different economy now, Tom. And that's why they've got all this inventory, and they've got to price down that inventory. And that's why I think we're seeing this big downside surprise on EPS, TK.
Yeah, there's no question about that as well. Right now, we're going to digress and move to Norway. Nicolai Tangen is Chief Executive Officer of the Norwegian Sovereign Wealth Fund. They are challenged by, as Target mentions, the uncertainty that is out there, and we are thrilled he joins us today with an update. Nicolai, you know that on the back end of the core algebraic function is a Greek letter epsilon for uncertainty. What is the level of uncertainty your sovereign wealth fund sees as you drift to 2023?
Well, I would say it's a continuation of the uncertainty we've seen for a year or so now. It consists of the inflation, the energy prices, and the geopolitics. And so it's a continuation of what we've seen for some time.
Well, with the situation that we're in leads to diversification. You people are, to use an American phrase, sir, ginormous. How do you diversify or choose bets given this uncertainty?
Well, first of all, we have a very long-term view on what we do. So we, invest with kind of a generation hat on. We spread over investments across the world. We have ownership in 9,000 companies across the world. We have both equities and bonds and real estate. So well-diversified portfolio for the long term.
What do you think of the American growth technology companies? Are you overweighting them? Do you own too much of them? I know the Swiss National Bank has a little bit of Apple as well, but is there the opportunity there in the tumult to reaffirm large cap growth?
Well, these companies are, of course, very, very big parts of the index. And so we would have big holdings in these companies. The US tech companies would typically be amongst our top 10 holdings, and we continue to think they are well positioned.
And clearly, we have seen a bit of a recovery in the equity markets in recent weeks, Nicolai. There is a bet on the part of the markets that we're going to see a more dovish tilt from Federal Reserve. How are you positioning potentially for Fed policy, and how ultimately do you think they will react? How does that inform your decision making going forward?
Well, that's a really, really tough one. We came into this year with some underweight in shares and a less risky bond portfolio. We've taken off some of that underweight, but we remain slightly cautious on the outlook here. Clearly markets don't go down in a straight line, and we are uncertain in terms of whether we've seen a bit of a bottoming here or whether we'll see a continuation of the tough market.
And of course, in addition to the monetary policy picture, there's a number of risks that the market has to weigh as well, including the ongoing war in Ukraine, which is now approaching 6 months. Have you come to any decisions around strategies of what your end game with your Russian assets is?
Well, when it comes to the Russian assets, we have been instructed by the government to exit these. for the time being, they don't really trade, and also we can't be certain about where they end up. So so they are still frozen, and we haven't sold them yet.
Nikolai, I'd like you to step away from the huge mass and the different responsibilities you have with your sovereign wealth fund and look at the heritage you have of hedge funds. It has been an absolute battle for hedge funds in timing the market. Obviously, they've got a much more shorter term mandate than what you have now. And then there's the question of long, short, and the different formulas of that. Is the alternative investment game over? Is the 2 and 20 game over?
Well, it's a tough one to say. I mean, it's over for me personally in that I now work for the sovereign wealth fund. But no, it's difficult to say. I mean, the returns from that asset class goes up and down. For the moment, they are having a tough time. They have previously bounced back from these type of situations, but I haven't really got a strong view on this.
I must ask Nikolai the view from Oslo of the rest of continental Europe. I've been working through the morning on natural gas equivalencies in dollar and in Brent crude barrels. That directly involves Norway. Your comments on how Norway and your investment fund will withstand what we're seeing in hydrocarbon prices?
Yeah, now energy prices are high, gas prices are high, but unfortunately for some sad reasons, the result is that we have big inflows into the fund, and we have big inflows into the fund at a time where bonds and equities are cheaper than they have been. So from that point of view, that's a bit of a silver lining from this fund.
Nikolai, always enjoy hearing from you, and what a time to hear from you as well. Difficult, complex, the future, with Nikolai Tangen there, the CEO of the Norwegian Sovereign Wealth Fund. I want to get back to the target news, a massive miss on EPS, and initially the stock dropping like a rock. It comes back. It's only negative 0.8%. I'll give you the numbers and then I'll tell you the why. EPS 39 cents, the estimate 72. That's a big miss. Here's the why that we're bouncing back. I think this line from the target CFO is so important. We know they've been grappling with a monster inventory issue. And to get that inventory out the door, they've had to cut prices, and seemingly pretty aggressively so. Here's the quote though, Tom. The vast majority of our inventory right-sizing costs have already been incurred. We feel really good about our inventory position heading into the back half of the year. Now, yes, and I agree with the team here at Bloomberg who put this out in their leading paragraph. It puts a lot of pressure on the back half of this year for Target. But Tom, I'll say this. You've basically got the C-suite telling us that inventory pain is essentially over.
I agree with that, and it's somewhat what we heard from Walmart yesterday. I'm doing John here. This is the TRA function, folks, on the Bloomberg terminal. Target, after the big pullback here from the 2021 peak, is clocking in 13% per year for the last decade, John. That's a pretty good number, but that's not a Target good number. And the difference here is you have a management, maybe more focused than Walmart, determined to fix it now. John, I would suggest that's what we've heard from Walmart and Target in the last 48 hours.
Yes, but we've been punished, Tom, by believing them and taking their word for it, because a couple of weeks later,
if you own the stock, you've been punished.
You've been punished, and we find out, Katie, that they have to cut the outlook again. That happened in May, it happened in June. Let's hope this is the case for them.
Yeah, well, especially as they're outlining what is supposed to be a better second half, John. Can they actually meet that mark? I think what's so interesting is also what the signals about the broader economy. In the statement, they're talking about how they still see a healthy consumer. Walmart yesterday talking about the fact that they're seeing consumers reroute their spending back toward some of those discretionary items because of lower gas prices. How much is the fate of these companies tied to the idea that prices at the pump are going to stay lower than they were?
The stock is down by about 1.8% right now. We'll stay on top of that for you. Futures are down 6 or 0.7% on the S&P. Tech's been a struggle the last couple of days, and that's that 100 down 0.8%. Got into retail sales a little bit later this morning. Yields higher by 5 or 6 basis points to 286. I mentioned it a little bit earlier in this hour. If you want to see a move in the bond market this morning, look no further than the UK. Double-digit inflation and yields higher at the front end. Tom, by 19 basis points on a 2-year. What a move.
9% inflation is different than 11% inflation, period. It's way more than 2 percentage points.
Futures down on the S&P with Tom Keene. I'm Jonathan Ferro, together with Katie Lyons. Bramo back with us on Monday. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. China is warning the U.S. not to sail warships through the Taiwan Strait. The Chinese ambassador to the U.S. said Beijing views such actions as an escalation by America. The Biden administration has said it would send warships and fighter jets through the strait. That is after China responded to House Speaker Nancy Pelosi's trip to Taiwan with a series of military exercises. Now, Goldman Sachs says that a deal to revive the nuclear agreement between Iran, the EU and the US is unlikely to be reached in the near term. The firm predicted that even if there is a breakthrough, additional oil from Iran won't start to flow until next year. The US is looking at Iran's response to a draft proposal of that agreement. Singapore is looking for a compromise while reviewing a colonial-era law that bans sex between men. That's according to the Deputy Prime Minister Lawrence Wong. He spoke to Bloomberg's editor-in-chief, John Micklethwaite, in his first interview since being endorsed as the next Prime Minister.
Things that they care about society, societal values, about family, about marriage. So it's not about the law per se, but about these other things. And that's why, as I mentioned just now, we are having this conversation even right now, engaging different groups and considering how best we might move forward in a way that will not cause deeper divisions in our society.
Taiwan is the only Asian jurisdiction that legally recognizes same-sex marriages. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I think we are running on thin ice, if I may use that term, because spare capacity is becoming scarce, and this is an issue. It's like an insurance policy. We don't want the oil markets to run on without the insurance policy.
That was Haytham Al-Ghais there, the Secretary General of OPEC, sitting down with a good friend of mine, Manus Cranny, and it was a fantastic interview. Take a look at that on Bloomberg.com and on the Bloomberg terminal if you have a spare 5 minutes or so. From New York City this morning, good morning with Tom Keene and Kelly Lyons. I'm Jonathan Ferro. Futures down 0.7% on the S&P. On the Nasdaq, we're down about 0.8%. Last 3 days, though, pretty good on the S&P 500, squeezing out 3 days of gains in the face of some pretty bad economic news. Can we say that, Tom? I think we can. It's been pretty bad across, say, Europe, China. I'd throw in that Empire Manufacturing as well in the United States too.
Well, the hallmark back 40 years of, John, when you see a double-digit inflation in Spain, you rationalize it. You can't rationalize double-digit inflation in the United Kingdom, a G7 nation, without just giving pause. There's no other way. We haven't talked much about it this morning, but there's really no other story socially.
The Bank of England's got to make a move off the back of that, Tom. Looking forward to their next meeting.
Of the Treasury.
You saw New Zealand overnight. I think they went with 50 basis points. They're now looking at a higher peak and seeing that higher peak a little bit sooner. They're not alone. They are not alone.
One of the great things we do, folks, is we do a book of the year. I made it in February. I've never done that early. Angela Stent's Putin's World, and maybe I work up a chart of the year in August to try to stagger to December. This year it's on hydrocarbons, and it will be math checked by Javier Blas, by Will Kennedy, and probably concept checked by Amrita Sen, Director of Research at Energy Aspect. She has been lights out in giving us the elasticities of what has now become a natural gas crisis. Amrita, I want you to explain to mere mortals like myself the enormity of the surge that we've seen in natural gas in Europe, in war-torn Europe, and quite frankly, around the world as well.
Well, I wouldn't call yourself a mere mortal, Tom, but there you go. I'll start with the gas question you've asked. Look, like you said, I mean, gas prices, even yesterday, even as oil continued to decline, we've seen gas prices in Europe, which is TTF, and even Henry Hub in the US, continue to rally. Of course, expectations remain that, with the war still going on, Russia could turn off gas, which is not our base case at all. But regardless of that, we are in a situation where demand continues to remain high. We are already seeing demand rationing in the industrial sector in Europe. We've already accounted for about 15 BCM of lost gas demand in Europe just because prices are too high. Now we are seeing industry where possible switching to oil, to liquids essentially, or to coal. So all of that is going on right now, but this is going to be a huge burden. We think as a result of high gas prices, European GDP is going to decline by 1.4% next year, which is contrary to IMF's, to a lot of consensus numbers out there who are still expecting growth. But we do think the burden of high gas and oil prices will actually mean that we are going to see some steep contraction in the European economies next year.
The contractions that we're going to see wrap around governments solving problems. Frankly, I've never seen a chart like I see in the Bloomberg. How do the governments solve the problem of a natural gas 6, 7, 8, 9 standard deviation surge?
What Europe has already started to talk about is the potential for rationing. They do have a plan. Again, our base case is that we will not need that because industry is already switching where possible. But so I think, but ultimately it does boil down to rationing, potentially even at the residential level now before the winter, so that we can save up enough gas for the winter.
Amrita, gas is climbing. We see that in Europe in a big way in the last couple of days. Crude isn't. And yet you've got the OPEC Secretary General sitting down with Manus Crani and telling him that we've got an issue with spare capacity. Now, Amrita, if that's the case, what are we doing in the 80s on WTI and the low 90s in Brent?
Oh, look, I couldn't agree with His Excellency, the new Secretary General, more. You know, we're good friends, and we've been talking about this, and he has highlighted this time and time again, that OPEC Plus doesn't have spare capacity. We've been saying that for 18 months. I mean, he talked about running on thin ice. Completely agree with that. We've got about 2 million barrels per day, we believe, if that, of global spare capacity. I would say right here, right now, the number is even lower. The reason oil prices are lower today is obviously concerns about Iran potentially coming back. Interestingly, ties back to gas. Because gas prices are high, people are expecting a recession, which will then curtail oil demand. Right now, there's not a lot of logic in the market. And the reason I say that is because, for sure, a weak economic growth environment is weak, as in it's bearish for oil, but ultimately it will also be bearish for gas. But somehow it's a very one-sided story right now. And I think a lot of traders are actually betting on, and they are putting on positions, which is long gas, short crude.
Amrita, you mentioned Iran and the question of whether or not a nuclear deal will actually be reached. A, what do you think the likelihood of that is? And B, even if one is reached, how long would it realistically take for those barrels to reach the market?
Look, I'm not trying to be like, or giving a cop-out answer, but right now, the chances of a deal are pretty much 50-50. We've been for a while saying that, look, the chances of a deal are very low, more like 15-20%. We do think the chances have risen. The movement has definitely come from the Iranian side. They have been struggling economically. Now, having said that, by no means is this a done deal. The way I would put it is that the Iranians have gone back to the EU draft. It's not a yes or a no. There's a lot of if statements in there. What we understand is nothing in there is as atrocious that the US and the Europeans will just throw it out straight away, saying that this is ridiculous. But there are some pretty tricky demands to meet. So this can still not happen. We don't have Iran in our balances. If Iran does come back, and especially because they've got about 65 to 70 million barrels in floating storage, you will see pressure on prices, particularly towards the back half of the year. Like you're saying, when can they come back? It will still take a minimum of 2 to 3 months because you need to go through some congressional approvals before sanctions can be lifted. That's going to be December before Iranian oil hits the market.
Amrita, thank you. Amrita Sen there of Energy Aspects. Nothing sleepy about the commodity market this year. Bit snoozy this morning, though. Unchanged on Brent essentially at 92.28. WTI positive almost 0.1%. Let's call it $86 and about 70 cents. Futures, though, we've got some price action. We're down 0.7 on the S&P, on the Nasdaq 100, down about 0.8%. You will notice yields are kicking higher on a US 10-year this morning. Right. Seeing Treasuries up 6 basis points there, 286.58, Tom. Though I have said it a few times this morning, if you need a bigger move than that, look to the UK. That move at the front end of the UK is just a monster move off the back of a monster upside surprise on UK CPI.
I don't know if you get an emergency meeting or not. I don't know enough about Bank of England. But, John, for the pros out there, there's an 11 ratio idea, the Bloomberg Financial Conditions Index. And we need this morning, John, to consider, will that accommodative trend index move from zero to a positive, very constructive accommodation. It's been a stunning move away from fear, away from a restrictive structure over the last 4 or 5 weeks.
Inflation in the UK, 10.1% in July, up from 9.4%, and we were looking for a move to 9.8%. So there's your double-digit CPI in the UK. Futures right now down 0.7 on the S&P. On the Nasdaq 100, down 0.8%. In just a moment, we'll catch up with the brilliant Gagi Chowdhury of BlackRock. That conversation about 4 minutes away from New York. Heard on radio, seen on TV. This is Bloomberg Surveillance.
The market's been enjoying the sunshine over the last few weeks, and I don't think that's going to last.
We're still reeling from the unevenness of both the reopening, the supply chain disruptions. An economy still kind of moving beyond the pandemic.
I think the market probably does not move materially higher from here. I think 4,300 will likely continue to be a resistance.
We think it's probably going to be growth that surprises us on the downside.
We are going to come out of this COVID crisis with a K-shaped recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I can confirm that TK is considering a Manchester United bid. I heard it a little bit early this morning. Tots, Tom. Okay, we'll talk about numbers in just a moment. From New York City this morning, good morning, good morning. For our audience worldwide, with Tom Keene, I'm Jonathan Ferro, together with the brilliant Kelly Lyons. Bramo coming back on Monday. Futures negative 0.6% on the S&P. TK, next big stop for this market rally. Retail sales 90 minutes away.
You see it in the opening comments there, and we've seen it with our head spinning on John's one-day hauls that extended into a week-long over, let's say, the last 10 days. John, I've never seen strategists with their head spinning, and it comes right back down to what we heard from Target 20 minutes ago. Guess what? It's all about the hope and prayer of a rebound. That's what every strategist is looking at.
Well, Tom, strategists are still pushing back. Mark Haefele of UBS this morning said we'd caution investors against chasing this rally. Yesterday, Citi said perhaps you should tactically sell into further strength, and perhaps that's justified. Their words, Tom, not mine. That's the wall of doubt in the face of a rally that's now 17.5% off the lows of June.
We haven't brought this up yet, John, but yesterday a lot of people picking up on a Bank of America note which said enough, where they've been, okay, up we go, we get a rebound, bear market rebound, and then it really, Michael Hartnett really paused the market yesterday.
You love that, Tom. I watched everyone try to say we're no longer apocalyptically bearish. But still too bearish to expect an immediate turnaround in the bear market rally. Katie Lyons, did you get all that?
Apocalyptically. It takes
no longer
some
apocalyptically
effort.
bearish.
Yeah, so the idea is that sentiment has improved, basically all predicated on this hope that we're going to get a dovish pivot from the Federal Reserve, that we've seen both peak inflation and peak central bank hawkishness, which is going to make the data this morning very important, and a lot more important for the Fed minutes coming at 2 p.m. Eastern time as well.
What was great, John, Dovish Pivot was a bar band down at UVA. They played Dave Matthews like nobody.
Is that the name of the bar?
Yeah.
Or
no,
the band?
The band was Dovish Pivot.
Okay.
They were really good.
Hawkish turn?
Sensitive.
Is that a good
they were
band?
Sensitive.
Were they opening for Dovish Pivot? Okay. All right, enough of that. Futures are down by 6 or 7/10% on the S&P. On the Nasdaq 100, we're down about 0.75%. Kaylee's going to guide you through the day ahead in just a moment. Just want to guide you through the bond market too. Big moves in the UK, big moves in Treasuries, up 6 basis points on 10s to 286.76. Double-digit CPI in the UK. Katie Lyons, that's the appetizer for the data still ahead of us.
Yep, 10.1% inflation. Absolutely brutal for the UK consumer and for the Bank of England, with traders now pricing in 200 basis points of hikes by May. Definitely something we're going to need to watch. But there's also a lot to watch in the day ahead. 8:30 a.m. Eastern is the big economic report here in the U.S. As we've been talking about retail sales, we're expecting growth of just 0.1% month on month on the headline. Ex-auto and gas, though, up 0.4%. How much will this report reflect an American consumer that is faced with lower prices at the pump, and as a result is able to shift some of their spending into other more discretionary areas? That's definitely something to keep an eye on. Then at 10:30 a.m. Eastern, we're going to get U.S. crude oil inventories. We're expecting a drawdown on crude inventories and an even bigger drawdown on gasoline inventories. It's a less, with crude down 29% so far since the peak in June, Tom. We have seen prices come dramatically lower. The idea was that this is demand destruction, right? Prices got too high, so people weren't
going to the pump as much. But if we're seeing a drawdown in inventories, does that send a more positive signal about a recovery in demand? Then finally, 2 p.m. Eastern time, Fed minutes from the July meeting will be crossing. We know they hiked 75 basis points. What we'll look for insight on is to their thinking around whether they're going to have to do that again. Right now, the market pricing essentially even odds of another 75 basis point hike come September. But of course, as we've seen this narrative building on a more dovish Federal Reserve, how much does the language in those minutes maybe push back on that idea, John?
Kaylee, teeing us up for Jackson Hole, Wyoming next week. TK, I think Jackson Hole's huge. I really do. The road to the September meeting is so long. We've got financial conditions easing aggressively into that meeting where a lot of people still expect them to hike somewhere between 50 basis points and 75.
Jackson Hole's always an unknown, but definitely, John, I tilt to the idea this will be a speech of substance just because of the midterm elections. He's got to get out front quicker than usual this year because of those important elections.
Since the middle of June, equities are up by 17.4% on the S&P 500. Credit spreads are much, much tighter. Gargi Chowdhury joins us now, the head of America's iShares investment strategy at BlackRock. Gargi, do you and the team trust this rally?
Good morning. It's great to be here, John, Tom, and Kaylee. So trust this rally. Well, it's definitely been a surprising one. We have been telling investors that they should remain invested, but really pick where in the markets they should be invested in. And we've been talking about looking at minimum volatility as an area of the market. We've been talking about healthcare providers. Certainly don't expect this rally to continue to have the same type of legs that we've seen, the 17% jump that you noted from the middle of June. That feels like it's maybe coming close to an end. But at the same time, I don't think that we're going to go back to the lows that we saw earlier this year, because much of the bad news that the market had to grapple with in the beginning of the year has already happened. We've seen that massive 300 basis point pricing of the Fed.
What's the level of pressure right now? We're getting right to the point where the year-end battle, and particularly conservative institutional money, is there. Year to date, Standard & Poor's 500, negative 10%. If I'm underperforming that, how do I recover to year end?
I think that there are a couple of areas of the market that certainly have brought about some opportunities. And we were listening to Amrita earlier talking about oil. I think not looking at commodities per se, but energy companies, which obviously are going to have a very good earnings period ahead because of their cash flows. I think that can and continues to provide a pretty interesting area of the market to invest in. Similarly, clean energy, I would say, is another area, especially given the recent bill that was passed. I also think fixed income, and Jonathan, I know we talked about this earlier last week in your show, but...
Oh, you did, on his other property.
We talked about the amazing yields of dreams.
It's real yield, Tom. That's where Gargi wished she was today. But unfortunately, it's only on Fridays at 1 p.m. and it's weekly. Carry on, Gargi, please.
We talked about yield of dreams, and I think fixed income is really attractive once again at some of these levels. You're looking for that extra credit in your portfolio, and looking at investment-grade credit, especially the shorter end of investment-grade credit, makes a lot of sense here. So there are some ways in which investors can, look to make a few basis points or a few percentage points back between now and the end of the year.
Okay, and maybe some places where you can still play defense as well. And yet, Gargi, what we've seen in recent weeks is a revival of some of those speculative areas of the equity market. I'm looking at Bed Bath & Beyond, up another 22% this morning after rallying 350% in the last 3 weeks. Growth stocks are leading once again. It seems like it's a return to 2021 almost. What kind of signal do you take from that activity?
I think that the signal that gives me is that real rates got to an area where perhaps the market thought that it's going to pause for a little bit. I think we were used to a period of rising real rates in the beginning of this year, and then they've paused. I certainly don't think that this is the point at which you're supposed to go all into growth stocks. I think there will be a time. It's not yet, because obviously we're still going to hear from the Fed, especially today, and obviously in Jackson Hole as well. And I think they're going to still guide us towards somewhat higher rates. So I don't think this is the moment yet to get back to growth stocks. I think some of this rally has probably been a combination of real rate stabilizing and also short covering, I would say. So I think there's going to be a point perhaps later this year, perhaps going into next year, where you're really going to have that opportunity to get back into growth stocks where we are going to get that pivot. It didn't come in the July meeting, even though the market certainly behaved as if it had. But I think there's going to be a time for the Fed pivot to happen, and it's not till perhaps later this year or earlier in 2023.
In the meantime, what should we do with inflation protection? Gargi, having followed your work closely this year, I think one defining position you still have is that you're not willing to fake the inflation story just yet. You still think investors should protect themselves. Can you walk us through the why and the where?
Sure. So what we've been seeing in the inflation data recently is this persistent strength, this stickiness in services inflation, especially in shelter inflation. And as we know, shelter inflation is about 40% of core inflation, and that's moving higher. On the other hand, what we're seeing is goods inflation actually coming down, and that's probably going to continue to do so. So looking ahead, I think the story is going to be around shelter inflation remaining higher and actually allowing for, unfortunately, core inflation to remain at least around this 5% level going into year end of 2022, perhaps coming down to maybe 3% or so next year, but that's still a very long time away. So where we think investors, especially fixed income investors that are looking to protect themselves against higher inflation, where they can play this is with shorter dated inflation-linked bonds. So not the entirety of the inflation-linked bond market, because of course that has a lot of duration, but also can often not do as well when growth slows down. But the front end is where you're going to get that carry. Front end is where you're going to get paid to own those bonds when inflation comes in higher between now and the next few years.
Gargi, this was awesome and great to see you in person here in New York City. Gargi Chowdhury there of BlackRock. Tom, I think what Gargi's doing there is talking about the next phase of this trade. What are we trading on right now? Peak year-over-year inflation, a mechanical peak as well, because it's all about base effects. So you get this peak year-over-year inflation, people get comfortable with that idea, they start repricing the terminal rate. Tom, the next phase of the discussion is the one that you've been having for months. It's the what next? Okay, 98765, where'd you settle? And if you settle down at 4, how much work does the Fed have to do? And do you have to reprice the terminal rate all over again?
I haven't seen the papers yet for Jackson Hole, nor has anyone else. The Kansas City Fed, to their great credit, keep that very quiet up to next week, Thursday-ish. But John, I think any paper we see on inflation trend dynamics is absolutely critical. Kalanovic at JP Morgan says we see a rapid move down in inflation, and others say not so much.
Looking forward to the coverage in Jackson Hole, Wyoming next week with the surveillance team and Mike McKee alongside us, making that even better. Yields up 6 basis points on a 10-year, 286.94. Equities down 7/10 on the S&P 500. In the next hour, the brilliant Alicia Levine of BNY Mellon. Looking forward to that conversation. And in just a moment, AMH down in DC. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Ukraine's President Volodymyr Zelensky has warned civilians to stay away from military facilities occupied by Russian forces. That followed explosions at a Russian ammo dump in Crimea. An advisor to Zelensky has said the blasts mark the beginning of a series of attacks. Last week, explosions at a Russian airbase in Crimea destroyed fighter jets. Now, here in the UK, inflation jumped more than expected last month to the highest level in 40 years. The consumer price index rose 10.1% in July from a year ago, following a 9.4% gain in June. That will put pressure on the British government and on the Bank of England to take action. Germany will struggle to have enough natural gas to get through the winter. That is according to the country's energy regulator, which says Germany will have enough gas for less than 3 months if Russia cuts off supplies completely. The country is racing to fill its winter stockpiles after Russia drastically reduced flows on the key Nord Stream pipeline. Target posted second quarter profit that badly missed estimates. Still, the discount retailer is sticking with its forecast of a dramatic rebound in the second half of its fiscal year. The profit plunge reflects decisions Target outlined in June to slash prices on home appliances, patio furniture and other discretionary items. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 20 countries. I'm Leanne Gerrans. This is Bloomberg.
I have said since January 6th that I will do whatever it takes to ensure Donald Trump is never again anywhere near the Oval Office, and I mean it.
Republican Congresswoman Liz Cheney there of Wyoming after losing her primary to someone else, and we're going to talk about that someone else, Ms. Hageman, in just a moment. From New York City this morning, good morning. Tom Keene, Kelly Lyons and Jonathan Ferro. Futures down 8 or 9% on the S&P. On the Nasdaq 100 down around about 1 full percentage point now. We roll over. Yields are higher by 7 basis points, 287.12 on a 10-year. And just a bit of news on Congresswoman Cheney, Tom, speaking on the Today Show on NBC, saying she's thinking about running for president, will make a decision in the coming months.
Probably Elon Musk is as well. John, can we pause here for a moment? Anne-Marie can pause and
sure.
Consider the view in Washington. That is 811 days from the 2024 election. Can we just state that the British do this better than we do?
I know you like saying that periodically, don't you, Tom? There is a long runway. It's the primaries, TK. You take so long to select a candidate for each party.
That is a good place to start with Anne-Marie Horton, who's expert on this. And, of course, we'll enjoy 2022, 23, and most of 24 as well. Anne-Marie, it is all about the primaries. Does the Cheney party, and I mean Vice President Cheney's party, are they even part of the GOP primary?
Not really. I mean, it's a great question. There are a number of candidates that Trump backed that did lose, but overwhelmingly his candidates won. And this is the stat we have in our morning brief. Of the 270 candidates for international, federal, state, local, and political positions Trump has endorsed since leaving office, 216 have won. A number ran unopposed, but only 17 have lost. He is clearly, even though he's not in office, even though he didn't win the 2020 election, he is clearly still the head of this party. And you see a number of candidates show fealty to him to want to make sure they could win. But in her concession speech, Liz Cheney said she could have done that to secure her political future in Wyoming, but she refused to.
Do the Democrats want President Trump to run, though?
Well, that's a great question, because a lot of Democrats would think that if you just have a rematch of 2020, Biden would still win.
Well, and the president has indicated as well that he does intend to run again in 2024. But as Tom alluded to, there is a lot of runway until we get to the presidential elections of 2024. What about the midterm elections of 2022? Can we really just talk about whether or not the fate of the Democratic Party has changed at all, given the small wins President Biden has been notching over the last several weeks, including the signing of the Inflation Reduction Act yesterday?
It's a great question. You know, Jonathan had been talking about this for months, actually saying he thought the timeline was potentially on people's sides in terms of inflation coming down, and they had a little bit of wiggle room, and they did have a very productive summer. There was a bipartisan gun legislation. They were able to secure the backing of Congress for Finland and Sweden to join NATO, and then, of course, you have their agenda they've been wanting to get through in terms of climate provisions, Medicare provisions, raising of some taxes, although, as Jonathan pointed out in the last hour, they're not exactly closing special interest loopholes. But this is something they could go home to their constituents and say, look at all the stuff we actually were able to get done. We were able to get that done because we have these slim majorities. Vote us back in. There's a long list of provisions we continue want to get done. Imagine a lot of people are going to say, put me back in office, I will work for family leave, and a number of other things that were originally on the close to $10 trillion Build Back Better. And also the other big thing that I think we were talking about every single day was gas prices. It has evaporated from the news because now what you have are gas prices that are pretty average for the everyday American consumer, under $4 a gallon. If that continues, this is certainly going to help the Democrats.
Down every single day since the middle of June. Quite remarkable. Yeah. We're talking about primaries here, AMH, and we could spend a long time talking about Republican primaries coming up on the horizon next year and beyond. Are we going to have primaries for the Democrats? I think that's the big question coming out of the midterms, whether the president can actually put to bed this idea that he's going to run in the second time for a second term, because when he says it and when people talk about it, there's so many people that don't believe him.
So two things. One, the president could not come out and say, I'm not running, right? Then he would be a lame duck. Potentially he could closer to 2024. But what we are hearing in the reporting is that he plans to run, even though you do have members of his party saying, thank you for beating the former President Trump. Now it's time to pass this on to a new generation. Following the midterms, this is going to be the most important discussion, I imagine, within the Democratic Party.
AMH, just briefly, anyone in Washington want to buy Manchester United? Any talk? The Cheney's thinking about it?
I'd love to buy a football team in the United Kingdom. No, so far there is not I haven't heard anyone in Washington looking to buy a sports team.
There we go. AMH, thank you.
At least not European football.
Elon Musk with a joke ad on Twitter. If you're just tuning in, it's just a joke. I'm buying Manchester United, you're welcome. He then said it was just a joke. Tom, we've put out an opinion column on Bloomberg. It's the tweet. Manchester United fans are so fed up with their current owners that even a joke bid from Elon Musk sounds like an improvement. How'd you like that, Tom? To think that the stock's up. The stock is up in the pre-market by 4.5%.
Yeah, but John, help us.
Of this.
John, help us here, because most of us, I like to play knowledgeable. I'm dumb as wood on this. John, just as simple as it can, it's the second week of the season. Don't these teams turn it around?
They can turn it around, Tom, if you've made the right transfers in the summer transfer window. And I think the problem is that people don't think they've made the right transfers in that window. They've still got a few weeks left, which means you might get a panic buy. And for that reason, TK, given their performance over the last couple of weeks, a lot of people don't think they can turn it around. It looks like mid-table mediocrity based on what we've seen so far. And if they're lucky.
Yeah. Anybody know an update on Musk and Twitter? Kaylee, are you up to speed on this? John and I aren't.
I think there's the debate about whether or not he's going to get content from all the Twitter employees he wants to. We'll look for what the outcome of the trial is in October. It's a saga that is ongoing, but it really just speaks to Elon Musk saying he's going to do things, that he wants to do things, and then backing out and manipulating markets along the way. John, you asked if anyone in Washington is looking to buy the team. I'm just wondering if anyone in Washington's looking at these tweets and saying, we need to do something to regulate this guy.
It's a publicly listed company, and we're just sort of joking about buying it. And of course, if I joke about buying it, no one believes it, and the stock doesn't move because I haven't got the money to buy it. But Tom, he's potentially got the money to buy something like that. And that's why some people take it seriously.
No, absolutely. Absolutely. And if he made, I'm going to be getting myself in trouble here.
Go on, do it. Go there.
No, please.
Okay.
if he did a Twitter, to be diplomatic about it, maybe the family would say, it's the Glazer family, right, John?
It's the Glazer family.
I get the teams mixed
They own the Tampa Bay Buccaneers, is that right, Tom?
Yeah, they own the Bradys.
The Bradys.
The Bradys.
Okay. Thank you, Tom. Futures down 0.8% on the S&P. In just a moment, we'll catch up with Mike Collins at PGIM. In about an hour and 5 minutes, we'll get retail sales in America. From New York, this is Bloomberg.
What?
We keep squeezing out a day of gains on the S&P 500. We've had 3 of them. This morning, we're starting the day like we started yesterday and the day before. Negative on the S&P 500, negative on the NASDAQ. We're down about 0.8 on the S&P. Rolling over again on the NASDAQ 100, down about 1 full percentage point, but quite a rally off the lows. We keep talking about it. Close to 17.5% off the lows on the S&P 500. Those June lows. And every single time we get a little bit of a burst of a rally, a little bit more, we get more pushback. Just a wall of doubt. You're hearing it from UBS this morning. The message from them is that maybe you shouldn't chase this rally. The message from Citi overnight, they're saying perhaps selling into strength might be justified. TK, how many times have we heard this? And this market keeps hopping over that wall of doubt.
We heard it on Jobs Day. We heard it on the CPI Day. And today is Retail Wednesday.
Retail sales, Tom. Retail sales Wednesday. I didn't get that in, did I? That's coming in about an hour. Look for that data point, Tom. I'll do that in every single tease through the rest of this show. All right, retail sales Wednesday coming up. So equities negative. Will these losses stick? Let's have a look. We're at the lows of the session, I think, at about negative 1% on the NASDAQ. And what we're seeing in the bond market is interesting. So what I want to do is look at the Treasury curve and then get global. Let's start with a 2-year in the US, up 9 basis points on a 2-year to 334.55. Just starting to get back towards that high for 2022 on a 2-year yield. On a 10-year Treasury, up 9 basis points as well to about 289. Wanted to start with the US and then get global, so let's get global. Let's let's just go over the Atlantic and go to the UK and go to Germany. Look at gilts and look at bunds. This move in the UK, off the back of double-digit CPI through 10%, we've got yields up on a 2-year. Not on the week, not on the month, not on the year, on the session, Tom, by 26 basis points. That's a big move for a big bond market.
Well, and again, I'm going to go to the persistency of higher inflation, John. We're talking about levels here, 9 point this, 10 point that, and whatever. But as you sustain up, there's got to be an increasing doubt that you can come down. To me, that's what's changed today.
What day is it, Tom? Retail sales Wednesday.
It's retail
there
sales
you go.
Wednesday.
Yields up in Germany as well. On the 2-year, they're up about 16 or 17 basis points. That's the cross-asset price action. Going into retail sales, we've got to talk about some retailers. Let's do that.
Retail. It's what it's all about today, John. Of course, you had Target reporting just about an hour ago. What was interesting is they have lowered the bar twice going into this report, and they still missed it by a huge margin. Earnings of just 39 cents per share. The estimate was 72 cents. You had the stock dropping like a rock initially on that, but the company saying that they've already worked through most of their inventory issues has it off the lows, though it's still down about 3.7% on that miss. For Lowe's, they're higher by about 1.6%. You had a beat on earnings and on operating margin, which is where that optimism is coming from. And interestingly, for TJX, they also raised their margin outlook for the fiscal year 2023 pre-tax. Yet the fact that comp sales were lower and revenue was a little light is taking the stock down a little more than 1%. Let's also talk about retail traders, or at least meme traders, because these stocks have made a ridiculous comeback in recent weeks. Bed Bath & Beyond is the new poster child. It's up 350% in the last 3 weeks alone, and it's higher. Oh, that's Best Buy, so that would be why that is. It's down 2%. Bed Bath & Beyond is up more like 20% right now before the bell. Thank you very much, Tom. And GameStop, of course, was the initial meme stock, is up 1.2%. Always got to work the Dow in there. Finally, just ending on Manchester United. This is a story we've talked about this morning. Elon Musk was just kidding. He's not buying the football team. I said soccer earlier and got a little bit of punishment for it. But look, the stock is still up 7.4%, even though he said it was a joke. And that is actually off the pre-market session highs. Right when pre-market trading opened at 4 a.m. Eastern time, that stock was up 17%. Talk about a man capable of moving a market.
I can clarify Bloomberg style, and you can share this with Matt Miller a little bit later, Kelly Lyons. According to our editor-in-chief, and this changed a number of months ago, Tom, it is football when you are talking about European football, world football. It is soccer if you are talking about the game being played here in the United States. So if you were talking about the MLS, you could refer to the sport as soccer. And if you're talking about anything else, you could talk about football. So we're talking about football now, Tom, and Manchester United. Is that helpful? Debate. Just in case, Tom, you were considering writing a story about it and what's happening this morning, and perhaps declaring your interest in another football club over in the UK.
The Tots play soccer and the Spurs play football. That's all there is.
Is that right?
To it. Michael Collins with us now. This is an important conversation. Senior portfolio manager at PGIM and steeped in the mathematics of Binghamton and other good universities as well. Michael, love talking to you about the dynamics of the moment. There's a major core debate on the glide path of disinflation. How does that fold into owning and husbanding yield right now?
Yeah, well, Tom, one thing we're seeing is this big tug of war between growth and inflation, right? And growth globally actually seems to be holding up pretty well. We've seen European GDP continue to be actually a little bit stronger than expected. And in the U.S., you know, we saw it in the labor market. We'll get retail sales in an hour, and real retail sales will probably continue to be really weak or slightly negative. But obviously, nominal retail sales are really strong. And inflation, right? Inflation, as you've all pointed out, especially in places like Europe and the UK, and to some extent the US, are really sticky. But that disinflationary trend is beginning to reemerge. We are seeing goods inflation. We are seeing leading indicators of goods inflation pointing towards zero goods inflation. And I would bet in the next 6-12 months, you see zero goods inflation globally in the U.S.
Yeah.
And I think that's a big deal. Obviously, services inflation is sticky, but I think that will give the Fed some optimism to slow down the pace of hikes.
And John, this is like Michael Collins is writing the speech for Jerome Powell, the separation here of services and goods.
Yeah.
How many people, John, are expecting a massive disinflation of goods? I'd say it's a lonely crowd.
So how much more work does this Fed need to do? With that in mind, I think this is so important. Mike, you've been in the camp that we've seen the higher the year on a 10-year yield. I wonder if that same theory applies to the 2-year. Something's happening quietly here with the 2-year yield. It peaked back in the middle of June, 2 days before the equity market bottomed at 345. Then it faded away and equities were off to the races, and we rallied really hard as we faded that real yield as well. We've seen that 2-year yield, the nominal yield, just pick up a fair bit as well, Mike. I just wonder what you think about that back at 334 on a 2-year in America.
Yeah, and the way us bond geeks look at it, as you know, Jonathan and Tom and Kaylee, we look at those forward rates and what's priced into the market. And right now, with this jump in the front end of the curve, the markets are pricing in, obviously, a higher terminal funds rate of getting close to 3 3/4. So the question is the Fed actually going to be able to engineer another 125, 150 basis points of rate hikes from here? And that is not clear. I mean, I don't have a lot of conviction either way on that. I mean, even if goods inflation goes to 0 and services inflation is at 5, that's still a 3.5%, core PCE or core CPI. I don't know if the Fed stops hiking at 3.5% unless growth is probably below 2. So I think it's this balancing act between growth and inflation. I like to think about it in nominal GDP terms. If you add those two up, if those two added up are below 4, let's say, maybe that's enough for the Fed to pause. But if they remain above 4, I think the Fed probably keeps going.
Well, John was talking about the work being done at the short end, and where that leaves the 2-year yield is about 45 basis points above that of the 10-year yield. How much further can this inversion go? What will the depths ultimately be, and how does your assumption of what the height of the Fed funds rate factor into that?
Yeah, that curve inversion has been, not totally unsurprising in a world where inflation is sticky, central banks all over the world are raising rates, and growth is moderating and slowing. You do see these flat and inverted curves. The question is, how deep can that inversion go? It's, negative 40-ish, call it 2s, 10s. Can it go to negative 80 or negative 100? Sure. I mean, if the funds rate ends up at 4 this cycle,
negative 100, Mike.
Probably...
Brian Weinstein of Morgan Stanley said the same thing last week too.
John was aware.
Sure. I mean, we're actually thinking over the next, we're long-term thinkers, as you all know, and long-term investors. Over the next 3 years, what is the curve going to look like? And I think it's going to be back to the old, bull steepener, where the Fed, by that point, will be cutting rates, and you'll have this big bull steepener. But in the meantime, it's really unclear which direction that curve shape is going. We're pretty flat right now in terms of the curve positioning because of the uncertainty. But yeah, I mean, if the Fed keeps going, the curve continues to invert.
So, Mike, given that, what business do high-yield spreads have being down at 400 basis points?
Yeah, we are in the camp, that you're supposed to really take some chips off the table here. I mean, yeah, credit quality has been sound. We've just started to see the first sign of some downgrades in the high yield market in some very specific sectors like cruise lines and healthcare. But by and large, the upgrades continue to outnumber downgrades. Credit quality is good. These companies are flush with cash. They've done a great job managing liquidity, managing the bottom lines. But valuations, I don't think right now, and maybe you could apply this to the stock market as well, the investment grade corporate market, may not be fully compensating investors for these big kind of tail risks that are still out there, right? I mean, we could have a deepening recession globally. That is certainly in the cards as well.
Mike Collins, just awesome to get you on the show. Let's catch up again soon. Mike Collins there of PGIM on the latest in this bond market, and TK within that, some big calls, potentially down to negative 100 on the yield curve, and that's a move. That's some real inversion.
Well, that's
and then pushing
huge.
back against the high yield spread tightness we've seen, the compression over the last couple of months.
Well, that's truly Volcker-like, and to go the other way, we've gone to remind everyone from negative 49 basis points out to negative 39, and we've come halfway back in 2 cups of coffee to negative 45 basis points in the 2-10 spread. I think it's like everything else, John. There's the disparity of opinions we're living here on Bloomberg surveillance is extraordinary.
Do you think that the yield move this morning, Tom, is connected to the weakness we're seeing in the equity market? The Nasdaq down about 1%.
We were negative 26 before the target earnings, and now we're negative 36. I think there's more going on, maybe in the last 10 minutes. You know, I'm not quite sure.
It's a big move. 8 basis points on 2s, on 10s, 8 basis points, and Kaylee, a whole lot bigger over in the UK and Germany.
Yeah, double that and more. The 2-year yield up 25 basis points on the back of 10.1% inflation. Talk about brutal, John.
Well, we've seen a bit of this through the week so far. Some weakness in the morning, and then we've bought that weakness and closed out with a day of gains. We'll see if we can repeat that act a little bit later. From New York, we'll catch up with Mike Dada at 8:30 Eastern Time. We'll do that just after the retail sales number drops in America. Tom, it is Retail Sales Wednesday. This is Bloomberg.
Nice promotion.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The new head of OPEC warns that global oil markets face a high risk of a supply squeeze this year. Haytham Al-Ghai sat down with Bloomberg TV in his first interview since taking office at the start of August.
I think we are running on thin ice, if I may use that term, because spare capacity is becoming scarce, and this is an issue. It's like an insurance policy. We don't want the oil markets to run on without the insurance policy.
Al-Ghai says that global demand will increase by almost 3 million barrels a day this year, boosted by China's return from lockdowns. Now, Goldman Sachs says that a deal to revive the nuclear agreement between Iran, the EU and the US is unlikely to be reached in the near term. The firm predicted that even if there is a breakthrough, additional oil from Iran won't start to flow until next year. The US is looking at Iran's response to a draft proposal of an agreement. China is warning the US not to sail warships through the Taiwan Strait. The Chinese ambassador to the US said Beijing's views such actions as an escalation by America. The Biden administration has said it would send warships and fighter jets through the strait. Now, that is after China responded to House Speaker Nancy Pelosi's trip to Taiwan with a series of military exercises. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The U.S. economy right now is in a stronger and a more resilient place than any other major economy globally to actually navigate the global challenges that we face, which include potential growth slowdown in China, which also include the impact of the war in Ukraine.
I throw in the potential of a recession in Europe too. That was Brian Deese, the director of the National Economic Council, and you'd have to say this White House has a relatively better story to tell over the last couple of weeks. With Tom Keene and Katie Lyons, I'm Jonathan Ferro. Futures are down by 8 or 9/10% on the S&P 500. NASDAQ 100 futures down by, let's call it, 1 full percentage point. And here's the move in the bond market. Yields higher by 8 basis points on a 10-year in the US, 288. I'd go to the UK, where you're seeing an explosive move higher in UK gilt yields, Tom, and I don't think I'm overdoing it using that language. Up 23 basis points on a 2-year, on a 10-year up 16 basis points on double-digit CPI in the United Kingdom.
The focus on explosive and the y-axis, up we go on inflation, and I would take it out again to the x-axis, John, and the persistency that we could see in continental and United Kingdom inflation. To give us perspective, always, Marcus Ashworth, who joins me each ECB day with Bloomberg Intelligence. Marcus, wonderful to have you with us this morning. How does the x-axis change when you go double-digit? Do you, in the theory that you read, believe a more persistent inflation because it is so high?
Yes, I think you have to. I think you have to expect wage negotiations to be harder because people see double-digit inflation. It's going to change psychology from people putting up restaurant prices to corporates, the whole schmear. It's going to be much harder for the Bank of England to react in the sense that they've lost the plot. Everyone can see they have. They're going to have to hike 50 basis points, not 25, at the September 10th meeting. The question is whether or not they hike more than they otherwise would, and that is less clear. I think we may get earlier, bigger rate hike now, but it still doesn't mean that the final peak rate or neutral rate will be that much different because we're going to get a recession here at this rate. 13%
Right.
inflation in October.
Marcus, the dynamics of the sterling cuts two ways: higher interest rates, up, stronger sterling, resilient sterling, and the other is the economic slowdown that you mentioned. Can sterling revisit John Major weakness off of this inflation?
Yes, it can. I mean, I don't think this makes much move for sterling either way. You can see, cable hasn't really budged. And a hike of 50 rather than 25 weirdly doesn't seem to affect the currency that much. This is all about the stunning money markets. The front end of the UK curve has been obliterated this morning. Everyone is badly positioned, lulled into a summer sense of contentment because the US number was a surprise drop, and we got a surprise bigger rise. That's really double bad news. A lot of people poorly positioned. You look at some like forward 1 year money market futures, they dropped by 100 basis points in price, as in 100 basis points up in yield in effect over the last 2 or 3 weeks. Everyone's got this position badly wrong and got too complacent, and they've been woken up sharply.
And Marcus, when you look at the breakdown, the composition of this move higher in UK inflation, food, energy, travel, what can the Bank of England actually do about this?
Well, I know, as I said, the double-digit number is going to cause them a lot of problems with the stickier supply side, the services sector, which is clearly coming through. That will worry them. The wage data yesterday was actually probably even more worrying for them because it shows that wage rises are actually pretty good. They're doing really well. It's just to take away inflation, and we're in negative situation as far as real incomes are concerned. But nonetheless, the actual drive of the economy in labor and in wages is strong. We know that the balance sheets of corporates and households and banks are strong. That's the fact that inflation is going to be a continuing problem for them. Petrol prices, gasoline will drop. So the next 2 months, we'll probably see a fallback in the headline rate. But we know in October, there is going to be a big energy price cap lift. It's going to push it up to 13% or possibly more.
It sounds like, listening to you, Marcus, that you think we get a two-punch combo here. The first one is this relief that you start to believe that we've had peak year-over-year inflation and that wasn't too bad, let's move on. Then we all relax and get punched in the face later this year. Do you think that's the same is true in the US? Tom's been talking about how sticky US inflation might come down to 5 or 6, and then ultimately what next? And this Fed is going to have a tough decision to make. Is that where you're at?
No, I think the UK's got a special situation. I don't think you can read it across from the US. I don't think that's necessarily quite as simple for the States. We've got a really odd situation. We've been fiscally tightening, which is the only country crazy enough to do that. But with regards to our price cap, we've decided to let the market run riot rather than keep a price lid on it like we have in Europe and subsidize people's incomes. Long term, that's probably the right thing to do. Short term, it's a very painful political thing, and it affects our inflation data. So ignore us, I think, is the best thing.
But Marcus, to that point, we've seen Labour say we want to freeze the price cap, hold it where it is. You have Rishi Sunak pushing back on that idea, Liz Truss warning against throwing money at a short-term solution. What is the appropriate fiscal response, not just monetary?
Well, we're stuck with a system which was created by the previous government, quite a few years ago. And look, it's trying to fix something midway through a crisis never works. We've got to stick with this. We've got to subsidize lower incomes, which they're doing. The price cap is a system which is, no system is great here. And I don't think what's going on in Europe is necessarily very healthy with having to bail out energy, the EDF, the French supplier, likewise in Germany. We're showing what the problems are. We're going to have to subsidize people's income. It's not a great way of going about things, but it's the way we've got, and we've got to have to stick with it, unfortunately.
Marcus, just quickly before you run, you're really on top of this story in a way that I'm not. Do we need to pay a little bit more attention to the prospect of the mandate of the Bank of England changing with a new government? How serious is this?
It's a red herring. I would ignore it. The only way this ever works if it's done with the agreement of the Bank of England. Bailey's admitted that he has to be open-minded. Look, with a 2% target and inflation 5 times that and going to more 6 or 7 times that, if he said anything else, he really shouldn't be in the job. Yes, there is a chance and should be looking at what has gone wrong. That's sensible in any organization. The Bank of England isn't immune from that. Whether they change it or not, as long as everyone's in agreement, that means the Bank of England, as well as the Treasury and the government, then it shouldn't be an issue.
Marcus, thank you. as always. Marcus Ashworth there.
Brilliant.
He's a rugby fan, Tom. He can't talk about the Manchester United news
Oh, it's like Guy
or
Johnson.
lack thereof.
Guy Johnson.
Guy Johnson's a rugby boy too.
Throws a drink at me. And all
Different
that.
different education, Tom.
What's
different
the
schools.
percentage difference between soccer and rugby in the United Kingdom? Is it like
Football.
10 to 1?
Tom.
Did he call it soccer again?
He did.
Is it like 10 to
TK.
1 or 5 to 1?
I don't know what the
or-
ratio is, Tom. But usually if you go to a posh school, you play rugby. And if you go to a state school, you play football.
I didn't know that.
Yeah, that's the thing, Tom.
I didn't know that.
Which is why we have that sort of famous phrase. Have you
Right.
ever heard a gentleman's game
Yeah.
played by hooligans and
Yeah.
a hooligan's game played by
Yeah.
gentlemen? You never
Kaylee-
heard that one before?
Kaylee, this just in. We need your advice here, Kaylee. Hope you're coming with us as well. We've got a good amount of people coming to Jackson Hole as well. John Farrell outfitted here. We're looking to Lucchese not only for the great boots that they make. Got a pair, my old boots tucked away at home in the closet. But I look at, John Farrell, and you look at John Wayne as well. Now, it's not a John Wayne look, but Wayne wore the Resistol felt hat of Garland,
I'm sorry,
Texas.
I'm looking at the price.
Yeah.
$495 for a hat.
The George Strait hat is $40 cheaper, but John, I just think this says you
Yeah,
in a more
that's a no.
urbane
That's a no
kind
from
of
me.
way.
Do you know what the kids are wearing now? Do you know what Anne-Marie's been wearing, Tom? A Prada bucket hat.
Oh,
It's
that's
about
very
bucket
in.
hats this
Yes.
summer, apparently.
Yeah.
Just buy the
Apparently that's thing.
knockoffs on Amazon.
John,
That's my
$500
advice.
bucks for a hat.
There's a Prada bucket
TK, no.
hat in the house.
No. No.
As inflation is easing, it's giving the Fed more wiggle room.
I think the key theme on the inflation front is going to be that divergence between headline inflation and core inflation.
Even though inflation may have peaked, I think the market is discounting that the Fed sticks the landing.
If we do head into a recession, the Fed and central banks around the world are going to cut rates more than is currently priced in.
I think the probabilities have increased for a soft landing. I don't think it's still the base case.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. This is Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Lisa is off. She's on a one-day house. We'll see how long that goes, like Farrow's house of last week. Kaylee Line's in today as well. It's not double-digit inflation in Spain or America. John, double-digit inflation in your United Kingdom. I was shocked.
Double-digit CPI, big upside surprise, a monster move at the front end of the yield curve in gilts, Tom. Yields up by more than 20 basis points, and I think that's the theme this morning. Yields higher in the UK and Germany, stateside too, and equities lower. The Nasdaq down by 0.9%.
Interesting to see how the Bank of England is represented at Jackson Hole when we travel there next week. John, in this hour, like jobs report, like CPI report, I'm sorry, retail sales matter.
It is a big print coming up in about 29 minutes. I'd caution, though, Tom, you've got to strip out gas. It's a month-on-month number.
Yes.
Gas prices have come down. That's going to distort the number a little bit, so look for that. We need to try and gauge the underlying demand. So that's what I'd look for at about 8:30. And then, Tom, it's on to Jackson Hole next week. Andrew Hollenhorst, the city, just published, and he said the risk is, given the interpretation of the Fed meeting as dovish when he doesn't think it was, and given the easing of financial conditions that we've had over the last couple of months, which they think is unwarranted, the risk is that Chairman Powell has to be a little bit hawkish at this Jackson Hole conference, Tom, a week or so away.
Well, we're data dependent as we go a week or so away. We just featured the Lucchese hat, the Resistol hat that John is looking at to be sure he's appropriately dressed for that event. Kaylee Lines, target out. What did we learn?
Well, we learned that they didn't set the bar low enough. Even after two outlook cuts, you still had earnings coming in well short of expectations. But we also learned that the reason why profitability was down so much, because they had to discount in order to work down inventories, they think most of that work is done. Therefore, the back half of the year looks better. The question now, Tom, is can they actually meet those higher expectations through year end? The stock is down this morning on those results.
Our guest is so important in the stock market now. John, let's get through the data check quickly here. I'm going to go to oil here, where we've got a churn still. Brent crude 92 and American oil $86 a barrel.
Crude down about 1/10%, but the move is in the Treasury market. Yields higher by 8 basis points to 288.58. I talked about that big move in the UK and Germany. Yields higher around the globe, and equities lower by 0.8% on the S&P. Just about off session lows on the Nasdaq, but some weakness here. Though, TK, as you've said repeatedly through this week, this is how we started most days this week. Monday, Tuesday, Wednesday, and then we've squeezed out a day of gains at the end of it all. A 3-day winning streak at the moment.
Standard & Poor's futures negative 26 when Target came out. They now stand a bit below that. at -33. We need to recalibrate as you do. We know the surveillance heads are spinning over all the different opinions. It would be good to get a strategy grounded in first-order condition mathematics. That's Alicia Levine, head of equities and capital market advisory at BNY Mellon, with some serious math chops. Out at the end of the algebraic function, there's an epsilon. It's a Greek letter. You and I used to look at it like, what's that mean? Now it really means something. What is the systemic risk we see right now?
So the systemic risk is that we've priced in the Goldilocks scenario, which is that the Fed manages to do the soft landing with inflation that's coming down on its own, so it doesn't have to go that last mile from the 4 to the 2%, and that the consumer more or less stays healthy even as the Fed hits the labor market, job openings, but not actual jobs. That's the Goldilocks scenario. It is possible, but that's what we're priced for. We've now got the S&P trading at 18 times forward earnings as the 10-year move lower. And you know, the risk is, of course, that stickiness of inflation that you've talked about this morning is going to make things a lot more difficult.
So, Alicia, how do you want to use that strength over the last couple of months? How do you reposition? What do you fade? Where do you fade? What's vulnerable?
So I think that what's vulnerable here are the stocks that have rallied the most. So when you think about the long duration tech stocks and the growth names, they've bounced back the most. They've bounced back because 10-years have moved lower. So I think there's going to be some sort of reversion to the mean there. I mean, I think that's what we've seen really all year. When sectors have become overbought or oversold, they tend to bounce back. We're coming into the most seasonally difficult time of the year, September and October, with a Goldilocks scenario priced in. Now, our investors stayed fully invested all the time. We don't trade around the market, so they've participated in this rally, but we do think that the inflation stickiness is not going away anytime soon. So the minutes today, I don't think are going to add anything necessarily new, because you've had this panoply of Fed speakers that have come out over the last 3 weeks, essentially trying to talk down expectations of a pivot. And all we've gotten is the 10-year moving lower and lower and lower, financial conditions going easier, and tech stocks rallying.
Alicia, Bank of America touched on this yesterday, and I'd like you to put it in English for us. They talked about us no longer being apocalyptically bearish, but we were still too bearish to get an immediate turnaround in the bear market rally. Can you translate that? Where's sentiment, and what does that mean for the prospect of a further move higher here?
So I think this rally took most strategists off guard, because the market and strategists were essentially pricing in a recession as the base case scenario, with earnings going lower. And what that means is that the risk is still higher because investors are still defensively positioned, meaning not buying duration and not really going all in on risk trades. And so with that, you could see a squeeze higher simply because you've had such a huge structural shift to the defensive side. The real pain in this market, as terrible as the first 5.5 months were the accounts that were defensively positioned starting in mid-June, because those positions got destroyed. So, you know, we tend to be very neutral. We tend to, you know, we tell our clients, stay fully invested, because you can't trade it. Because when it turns, you're not going to get those upward moves.
Alicia, you mentioned earnings there, and of course we're at the tail end now of the second quarter earnings season. There's only about 30 companies in the S&P 500 left to report, and by and large, it's been pretty decent, at least relative to expectations. Average revenue growth of 14%, earnings growth of 8.4%. Both have been surprising to the upside more often than not. Looking forward, though, are we too optimistic about the trajectory of earnings through the back half of the year?
So look, earnings season has definitely come in better than feared. I think some of that was definitely the impact of inflation, because earnings are nominal, so much better. And I think some of the retail reports we've gotten over the last couple of days have actually come in better than feared. Mm-hmm. And with some optimism looking forward, I'd say this, I think that the fall in gas prices is really something very interesting, because while in one sense, it's disinflationary. On the other hand, if you're putting lower gas prices on top of an economy where workers are getting 5.5% wage increases, you do see that there's more spending power there. And if July is better than June because of falling energy prices, then you have to wonder whether what direction inflation really is going in. If you look at new orders on the ISM, that tends to be predictive of where S&P earnings are going by about 6 months. We've been under 50 for a couple of months, and at 48, it tends to mean that your S&P earnings will be moving lower in the next 6 months. We're just not there yet.
You and I were reminiscing, you were too young for it, but we were talking about the joys of turkey tetrazzini with a can of Campbell's cream of celery soup. There's a whole analysis going on now of the Dow Jones Industrial Average of the inflation now versus the inflation back when I was eating turkey tetrazzini at school. This inflation's different than that inflation, right?
This inflation's different because essentially it's been driven, one, by commodities, but also on the service sector and the wage side.
It's a different America. It's a different economy, right?
Totally different economy. We're not manufacturing-based anymore. We're a service-based economy. And so when the inflation is on the services side, it's going to be harder to get it down.
And also, we're more heterogeneous. I mean, back then it was a more aggregated analysis, and you can't do that now, which is where factor analysis is more important, right?
It is more important. I think the interesting thing to watch is, even as we've talked about the lower-end consumer struggling, it is completely obvious that the higher-end consumer is not just doing fine, spending, in a profligate way, supporting the economy and supporting corporate America. And so I think that's different. The range in income and what the effect of top-line 9% inflation means is very different.
Yeah, and John, do you know turkey tetrazzini, John? Was that an English thing?
I wasn't familiar with that, Tom. No.
The big debate with
you have to go to Brown for that.
Yeah, the big debate with turkey tetrazzini is: do you put the soup in before the Parmesan cheese or after the Parmesan cheese?
Work out which part of this is winding me up, Tom. The meal or the Dow Jones reference with the meal, or
back
both?
then, that's all there was. In fact, still that's all there is.
Sure, no doubt. Where's the Dow now?
The Dow now?
Yeah, where
it's
are we?
Down 186.
There we go. Thank you, Tom.
Come on, we printed 34,000. Within the gloom out there, Alicia Levine is pushed against the gloom. We're 2,000 Dow points away from nirvana.
Point change on the Dow, Tom. You're killing me. Alicia Levine, be on White Melon, Wealth Management.
The turkey tetrazzini will kill you,
awesome
John.
to have you with us in the studio. The joke of the day, Tom, on Elon Musk. What would Elon Musk technology bring to Manchester United anyway? They've been driverless for about 9 years already. You only get that if you're a Man U fan, but that's from Tom Williams out on Twitter. Tom, what a mess that whole story is this morning. We keep joking about it, but there you are, one of the richest men in the world.
It's not funny.
You're joking about buying a public company and then saying you're joking.
Why
it takes you 4 hours to say you're joking.
Why does
I don't know.
John, why does this guy have a different rule book? I don't get it. I don't get it
either. I don't get why the stock's still up. Either off the back of
That's
it.
a story. Are the TOTs publicly traded? I don't think so.
We'll get you some shares, Tom. We'll work that out. I'll talk to Levy for you. Do you think Levy will sort that out for you, Tom?
He will.
Dish out some stock. Futures down 7/10 on the S&P. Yields up 8 basis points, 288. Retail sales in America, 20 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Ukraine's President Volodymyr Zelensky has warned civilians to stay away from military facilities occupied by Russian forces. That followed explosions at a Russian ammo dump over in Crimea. An advisor to Zelensky has said the blasts mark the beginning of a series of attacks. Last week, explosions at a Russian airbase in Crimea did destroy fighter jets. Here in the UK, inflation jumped more than expected last month to the highest level in 40 years. The consumer price index rose 10.1% in July from a year ago, following a 9.4% gain in June. That will put pressure on the British government and on the Bank of England to take action. In Wyoming, Republican Congresswoman Liz Cheney has called on Americans to prevent Donald Trump from winning the White House again. Cheney suffered a crushing defeat to a primary challenger backed by the former president. She had become an outcast in her very own party for her strong anti-Trump stance. Target posted second quarter profit that badly missed estimates. Still, the discount retailer is sticking with its forecast of a dramatic rebound in the second half of its fiscal year. The profit plunge reflects decisions Target outlined in June to slash prices on home appliances, patio furniture and other discretionary items. And Lowe has reported comparable sales for the second quarter that missed estimates. The home improvement chain was hurt by a slumping U.S. housing market and the highest highest inflation in decades. Earnings were better than expected. Lowe's expects same-store sales for the year to be at a low end of the range of the forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
I think the market probably does not move materially higher from here. I think 4,300 will likely continue to be a resistance. But probably the biggest takeaway is that maybe we don't have to retest the lows that we have seen of 3,700.
That was Anastasia Amoroso, the chief investment strategist at iCapital. This morning, we're lower. Good morning. We're down 0.75% on the S&P 500. On the Nasdaq 100, down 8 or 0.9%. Seeing yields in the UK explode higher off the back of double-digit CPI. We're seeing a similar move on the German Bund curve. And on Treasuries, yields up by 9 basis points on a 10-year, 2.8913. The best piece of feedback I've had all week, Tom, has been on the Bloomberg B unit. Available on the iPhone now, downloaded as an app. Had a ton of engagement off that yesterday. So if you're a Bloomberg Terminal subscriber, it's available to you, Tom, on iOS.
Yeah, really revolutionary. Of course, the B unit itself was revolutionary. I'm going to say 12, 15 years ago as well. This is a security system, folks, to log on to the Bloomberg Terminal, which is a valuable commodity. So we're always working at that technology, led by Tom Secunda.
Very cool, Tom. Yeah. Very cool. People used to take this into a bar. You know, throw it across the table and let people know that they were important, that their company invested real money in them, and they had one of these.
Yeah.
What is that thing?
There is that thing, and we say thank you to all in technology driving forward the terminal each and every day. Driving forward the retail discussion always is Dana Telsey. She's CEO, Chief Research Officer of Telsey Advisory Group, but far more than that. As no one in the game, except maybe Vanessa Friedman at the New York Times, she is invested in the style and the fabric of retail America. Dana, I'm going to break a rule here. I usually start with big box or mid-market, whatever, but I've got to go to the fact of a surge in luxury goods. I see LVMH 7%, maybe 8% from a record high. All the others are doing it as well. Is luxury an old story where you can't invest now, or can luxury continue to be a value for our viewers and listeners?
I think luxury can continue to be a value for your viewers and listeners. Keep in mind, this luxury strength is happening regardless of the fact that the Chinese aren't traveling. So you haven't had travel from the Chinese. It's been the local Europeans, the local Americans, Americans going to Europe, where we've seen the strength of luxury. And certainly when we start to see the lockdowns decelerate in China and they start to travel, that's a benefit. And let's not forget that for the past 2 years with the pandemic, social occasions haven't been celebrated. So yes, we have 2.6 million weddings occurring in the US this year compared to 2.1 million on average. But even next year, there's going to be more to celebrate. And the luxury pendulum certainly seems to be able to gain a benefit.
And just as an aside, folks, I'm pleased to report that Kaylee Lines is going to 2.45 million of those weddings this summer as well. Dana, let's bring it down market then from luxury as well. There's a mid-market, call it Kohl's. I'll let you decide. Maybe it's Neiman Marcus. How's mid-market retail doing away from big box and the low end?
I mean, mid-market is right there in the mid-market, but it's slower. I mean, every single company is talked about the fact that whether it was from late May or early June till mid-July, there were pressure points. The consumer stopped spending. That consumer who basically is below $100,000 income was pressured by rising gas prices. All of a sudden, you hear them going to the grocery and they're trading down from potentially meat to chicken to pasta. And so the daily living essentials became more expensive. Marry that with the fact that you're lapping stimulus, lapping child tax credits, and it definitely is a pressure point in terms of spend. Also, don't forget, we have a lot of inventory. The disruption of supply chain brought in goods at the wrong time, and we're set up for continuing promotional impacts out there.
On that inventory issue, specifically in Target's release, which John rightly pointed out earlier, the company's CFO saying the vast majority of our inventory rightsizing costs have already been incurred. Do you buy that the worst of the inventory issue is over for these retailers?
The costs may have been incurred, but the promotions are still ongoing. And what I'm still hearing from retailers is there's still a mismatch, and we're still going to have certainly more goods available in September or October for these off-pricers to benefit from.
Dana, I just want to finish here. To what extent in luxury is it being propped up by some kind of shadow banking effort, buy now, pay later story? I see so many people wearing a brand that I just don't understand. It's Balenciaga. And I can go on a rant about that another time. These are $1,000, $1,500 hoodies. They're $600 T-shirts. Dana, we're all told that it's a struggle right now in America, yet the line is right around the corner, downtown in Soho. So, Dana, can you tell me, how are these things being paid for?
So I see what you see, because I've seen those lines also, and how is it being paid for? And while it may not be buy now, pay later, it may be on credit card where they're just paying a certain amount every single month. Because what we've heard lately is even the buy now, pay later, some of those sales have moderated from what they've been. And we certainly know that what people are cherishing is they are cherishing those luxury brands and the sneakers. Every designer is making sneakers that are selling.
Dana Taussig, thank you. Of Taussig Advisory, always brilliant. TK, it's so expensive for what it is. And I'm not signaling out a single brand. It's so many others as well. And yet, seemingly, Tom, even if it's Gucci, Louis Vuitton, you can do buy now, pay later on shops, Tom. That I remember being a kid as a family. If my mum wanted to go in there just to look, you were given these evil stares to walk back out because you couldn't afford the stuff. And these days, Tom, everyone can. Because you can go in, buy now, pay later.
I agree. It's a part of the merchandising where people are leveraging up on desires, particularly after 2 years of this. But, John, I'd say more than that. The oddest thing here are the margins that are generated and the labor required for these explosive sales. The labor models of these luxury companies are absolutely original. They're desperate to get craftsmen who can make the product. It's a huge issue in Europe and particularly in Italy.
Well, you're speaking of Hermes and the likes, particularly Tom, or others as well.
Well, no, I think Hermes the Dumas family has their own approach, which is they're setting up leather manufacturing facilities, small ones, all across France. They have said we're going to invest in France, and they're going to do this with hubs throughout many, many different cities and villages in France. That's one approach.
It just seems to me, Tom, the consumer attitudes about these goods now has just changed. It's not about the price tag, it's about the monthly figure.
I mean, well, we see this with Lisa and Kaylee every day. I mean, you know,
I blame Instagram culture.
Do you blame it on that?
Tell us about that.
Sure. I mean, you see these people who look just like you, they're about your age, wearing all of these designer goods, and you want to be like them. It's the impact of social media. Oh, yeah. I think it actually is economic. It's an economic force.
John, pro tip, the I can't even pronounce it, the Balenciaga sweatshirt, it will shrink in the dryer. We know this.
I don't own one, but thanks for the heads up.
You might buy a $500 hat, though.
Down 8 cents at 1%. Yes, no thanks. From New York, this is Bloomberg. It is Retail Sales Wednesday. That's what TK's calling it. Mike McKee's going to break down that number for you in just a moment. Futures going into it, down 0.8 cents of 1% on the S&P 500. On the Nasdaq 100, down by 1 full percentage point, with yields higher by 9 basis points. Call it 10 basis points higher now. With your economic data, here's Mike McKee.
Good morning, John and Kaylee. The Fed is on the phone for you. You need to go shopping because retail sales come in flat for the month of July. No change in the retail sales figures overall. And the retail sales control group, that one hasn't come in yet, but ex-autos up 0.4%, and that is down from a 1% move prior month. And ex-autos and gas up 0.7. So I'm guessing, and I'm just going to look quickly here, that gasoline played a big role in this. Gasoline stations down 1.8%, and we did see prices fall during the month, and retail sales are calculated in dollar terms. So overall, that is good news. Motor vehicles were down 1.6%. John, we'll talk a little bit about that on the open coming up. Furniture and home builders up just 0.2% after a bigger gain last month. So it looks like reasonably healthy in some areas. Building materials still up 1.5%. We saw those good results from Home Depot the other day. Grocery stores just 0.2 higher. And clothing and accessories stores, these are the people who are not buying the Balenciagas because they were down 0.6%. Tom Keene helped out, though. Food services and drinking places up 0.1%. Just 0.1%, though, Tom. You got more work to do.
Food service and drinking places. Futures down 0.9%, Mike, on the S&P, and the Nasdaq 100 down 1.4 percentage point. In the bond market, seeing a bit of response to this. So the front end now up by 11 basis points to 336 on a 10-year yield, higher by 10 basis points to about 290. Mike, I think the initial knee-jerk reaction here is to trade on the figure ex-gas for good reason. As you just pointed out, that comes in with a decent upside surprise. The control group as well, a decent upside surprise. Mike, is that the right way of looking at this number? Strip out the gas figure month over month?
Yeah, I think that's what the market is doing. The retail control figure, which takes out gasoline and autos and home improvement stuff, is up 0.8%. Those go into GDP and other areas. And, of course, gasoline prices fell significantly. But the retail control group, which is basically all the other stuff that people buy, was up reasonably well. The prior month had been at 0.8, revised down to 0.7, but still the 2 months together show Americans still were shopping, and that's why I think you're getting the higher yield reaction, because people are thinking the economy may be a bit stronger. Of course, that means more work for the Fed.
Hey, Mike, looking forward to your coverage in the next hour. We'll break this down on Bloomberg TV as we run towards the opening bout. Tom,
the markets.
Looking at yields, up 11 basis points on a 2-year, on a 10-year up 10 basis points. And this is what the street was focused on, the retail sales number ex-gas, because of what's happened with gas prices over the last month or so, Tom. And we get a decent upside surprise there.
Yeah, very quickly before our steam gas, 2-10 spread reinverts down to negative 47 basis points, not through negative 50, but nevertheless that bears watching. The real yield is a little bit of a higher yield, and dollar resiliency, dollar strength here as well. Michael Darda joins us, chief economist and macro strategist at MKM Partners. And what's wonderful about his work is how he synthesizes the economic view into the equity belief. Michael, I'm not going to mince words. In my umpteen years of doing this, I've never seen the raging debate about the stock market linked to the mysteries of our economy. Do you feel the same way? Do you see record uncertainty out there?
Well, Tom, one of the last times I was on in the dark days of mid-June, one of my messages for your retail investors was not to get too negative, even though the S&P 500 was down almost 24%. And the reason for that was it's notoriously difficult, probably impossible, to time market bottoms. And what we were seeing with the big decline in equity markets in the first 6 months of the year was mostly a rate shock, the 10-year yield going from 1.5% to almost 3.5%. But we're well off the highs in terms of the 10-year Treasury yield, even though the rates bumped up today with the good data. And the stock market is now up 17+% from the lows. So the first 6 months of the year, the equity market decline really wasn't about negative GDP or recession or a big earnings crash. It was about a valuation adjustment as the 10-year yield moved up. And that adjustment is now mostly in the rearview mirror.
I look, Michael, at the view forward, and the view forward ends with a thud. I believe it's on Thursday or Friday next week at Jackson Hole. What does Chairman Powell not want to do in his speech at Jackson Hole?
Well, we've seen a bevy of recent Fed speakers out there with essentially the same message, which is that they're going to continue to persist in pushing the front end of the curve up, meaning the policy rates and those rates most closely tied to it. And they're not going to be deterred. They expect some economic slowing, but they want to be very certain that inflation comes down and stays down, and that inflation expectations stay anchored at low levels. So they're going to persist with the rate hikes. They're going to persist at a slower pace, though, and that's what the market has gotten wind of, and I think that's the main reason that we've seen this big equity market move off of the lows and the stabilization in the long end of the curve. The Fed can do whatever it wants with short rates. It doesn't mean the long rates are going to go along with it. So we're seeing an increasing array of yield curves move into inversion now. And that is a cautionary tale about 2023. But I think the mistake that some people made with the yield curve is that it's not an immediate indicator of imminent recession. It tends to be a long leading indicator. The bond market is simply saying the short rates are going to go up above 3, but they're not going to persist there for years and years and years because the economy won't be able to take it.
So, Mike, do you think, though, that the easing of financial conditions we have seen are undermining what this Fed is trying to achieve? And how do you think this Fed chair is going to address some of that next week in Jackson Hole?
Yeah, that seems to be the perception of some of the Fed speakers that are trying to push pretty hard against this idea of 2023 rate cuts. But they really have no idea what the 2023 economy is going to look like. I would say this, if financial conditions are easing because credit spreads are narrowing now from the highs and equities are off the lows very strongly, does that warrant more Fed tightening than would otherwise be the case? I would say only if inflation expectations are also rising in sympathy. But bond market inflation expectations are well off the highs and they've recently stabilized. And so I don't think that the recent so-called easing of financial conditions necessarily means the Fed has to be a whole lot more aggressive. If they choose to do so, then certainly that simply amplifies the risks of a downturn in 2023.
Yeah.
That's the FOMC seems willing to take here because they really do want to ensure that inflation comes down, stays down, and that those inflation expectations stay anchored at low levels.
Well, on the point of those inflation expectations, Mike, which you've mentioned a few times now, we know a lot of that caters on the price of oil, which has come down, and that is reflected in those inflation expectations moving lower and in the retail sales data today with what we're seeing with the ex-auto and gas and control figures. Is too much predicated on pricing at the pump staying low when we had the OPEC new Secretary General telling Bloomberg earlier today that he sees the likelihood of a supply squeeze this year?
Yeah, it's possible. Those break-even spreads do move around based on shocks on energy prices and gasoline, but it's not entirely driven by that. So there certainly is some interplay there. I really think the best thing the Fed could do here is to watch the evolution of nominal spending in the second half of the year. In the first half, nominal GDP was very strong, high single digits, but we didn't have much real GDP growth. I think that is going to change because it's not just energy. You see metals down very sharply from the highs. I mentioned the break-evens. We have a whole array of yield curves going into inversion, much slower money supply growth. So the whole front edge of the reflation and inflation and nominal GDP surge has rolled over. And so I think in the second half of the year, we're going to see slower and more appropriate nominal GDP growth on the back of tighter monetary policy.
Mike, the path forward, what a complex one. Mike Data there of MKM Partners off the back of a retail sales print that on the headline number disappoints a little bit. But once you strip out gasoline, given what's happened with prices over the last month, you get a decent gauge of underlying strength for the US consumer and US retail sales. Futures still negative by 0.8% on the S&P, but TK, that move in the yield curve still there, up about 8 basis points to the front end on 2s, on 10s. Let's call it 9 basis points higher.
Yeah, I think it's a constructive adjustment, which takes away from the gloom of recession as well. But it also shows the parts of America that are affected. I mean, if gas is a problem, that really affects low income, and that's what we've seen within low income at retail. John, we have an international audience. Maria in Brussels sends in a terse email to correct me. It is a surveillance break exclusive that Balenciaga, did you know, John? From Spain, Cristobal.
I got the same message, Tom, but I thought you called it Spanish. I thought we called it Spanish.
I think we did, but maybe it was lost in translation.
Where is Maria? I haven't seen her for weeks.
I don't know what she's doing. She's like on sabbatical. She's on Halls.
She's on Halls?
Yeah.
On a long European vacation?
Yeah, it's the Spanish way.
We've got to catch up with Maria Tadeo. Is that Spanish, Tom? That's Spanish too.
She's probably looking for me to make an acquisition of Balenciaga.
Try and keep out of trouble for the rest of this week. Tom, the data's in now ahead of Jackson Hole. That's kind of it. For them, I wonder what kind of job they think they've got to do when they communicate next week.
I think we're going to get in 5 different flavors data dependency. I mean, that's all they can do. And they have to be data dependent, not because it's a theory, John, but because this is an original, all agree this is an original recovery because of a medical disaster. This is not normal analysis.
Mike McKee and I started having the conversation yesterday, Kaylee, just as a suggestion maybe that this easing of financial conditions is undesirable for them, and perhaps there's going to be a big coordinated effort to push back.
Yeah, it's not what they want to see. They want to see those tighten. And especially for Chairman Powell, who for whatever reason was perceived as dovish in that July press conference, whether or not that was his intention, does he now try to correct that narrative in a big way next week?
This market hasn't looked back since the middle of June. Kaylee, awesome to have you with us. You're back tomorrow?
I am.
Awesome.
All week, John.
And Friday? And
Well,
then
that's
Bramo's
if
going to
Lisa
be back
doesn't
next
get
week.
back. It's a one-day halt.
Bramo's taken a one-day halt, Tom, that turned into a long weekend. And she'll be back on Monday before we go to Jackson Hole, Wyoming for the Fed's annual symposium. Looking forward to it. Coming up at the Open, we'll catch up with Peter Cheer of Academy Securities, Elise Ossenbar of JP Morgan, Keith Lerner of Truist Advisors. We'll do all of that as we guide you towards the Open and Bout. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the First Word News, I'm Leanne Gerrans. China is warning the U.S. not to sail warships through the Taiwan Strait. The Chinese ambassador to the U.S. said Beijing views such actions as an escalation by America. The Biden administration has said it would send warships and fighter jets through the strait. That is after China responded to House Speaker Nancy Pelosi's trip to Taiwan with a series of military exercises. Now, Goldman Sachs says that a deal to revive the nuclear agreement between Iran, the EU and the US is unlikely to reach a deal in the near term. The firm predicted that even if there is a breakthrough, additional oil from Iran won't start to flow until next year. The US is looking at Iran's response to a draft proposal of an agreement. The Hong Kong Stock Exchange is forecasting a pickup in IPOs next year. CEO Nicholas Agazan spoke to Bloomberg TV.
I feel confident given the number of IPOs that we have in the pipeline. We've had 16 IPOs in July. I mean, so very, very good performance. Now we had all those IPOs and the pipeline still around 180. So the pipeline was replenished.
The Hong Kong's exchange net profit fell 27% in the first half of this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public company owned or public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States.
He is the chemical engineer of Queensland, greatly associated with Brisbane, where he will lead the Olympic effort of 10 years out. Andrew Liveris, you know him from Dow Chemical, of course, and now in one of his many affiliations, Lucid Group chairman. He'll be interviewed by David Rubenstein. You'll see that tonight at 9 p.m. Peer-to-peer conversations with Mr. Rubenstein, and he joins us this morning to speak of this really most interesting guy. And what's great about Andrew Liveris is he's really hardwired into the hopes and beliefs, the prayers of an American renaissance in manufacturing. Is it for real?
Well, he thinks so. He thinks that the manufacturing loss we had in textiles and other kinds of things that were dependent on labor costs is not relevant for the future of high-tech manufacturing. He thinks we can be a leader in high-tech manufacturing because that depends on supply chain and other related things, not so much on the cost of labor. But Andrew is an incredibly diverse person in his interests. He's from Australia, of Greek immigrant background. He ran Dow Chemical as president and CEO for 14 years, merged it into DuPont. Now he's the chairman of Lucid Motors, which is an electric vehicle upscale car. Mm-hmm. He's also an advisor to the Saudi Sovereign Wealth Fund. He's also on the board of Saudi Aramco. And as you note, he is also the chairman of the Olympics for Brisbane in 2030. 32. Right.
You and I can't think out that far.
Right.
We're going to be here for it, though, David.
Well,
I swear. Kayla, you know, I look at this, and so much for me, Andrew Liveris is about process. He's the process guy in American business.
Yeah, and he's trying to build something with this EV company in particular. But David, obviously, when we talk about EVs, the comparison always is to Tesla, who in many ways, Elon Musk was a first mover on this. How does he see them competing, whether or not they realistically can?
Well, Tesla is designed to produce cars, I won't say for the average person, they're not inexpensive, but they're not going after the luxury market. At the moment, Lucid is really going after the luxury market. Its cars begin at over $100,000 per vehicle, and they go up from there. They will address the lower cost market later on, but right now they're focused on the upscale market, and that's why they're not directly competing with Tesla.
Well, and of course, the U.S. has been looking at making more investments into the EV infrastructure space. That's part of what we see with the clean energy spending in the Inflation Reduction Act that the president just signed yesterday. What were his thoughts on U.S. infrastructure policy, what it ultimately needs to look like?
Well, Andrew Liveris has been involved in advising several presidents on infrastructure spending, and now that we have a bill, hopefully there'll be appropriations behind the bill. Remember, the bill was only to authorize spending. We have to actually appropriate the money. But assuming it's appropriated, we can begin to redo some of our bridges and roads and toll roads, airports, and things like that, which should make EV cars more accessible, too, because they're going to build out a fair amount of electric charging stations throughout the country.
David, I have to turn to the issue at hand, and I know these are delicate discussions. You don't want to talk specifically about the Carlyle Group, but I do want to talk about scale and heritage. Dow Chemical of Andrew Liveris is 35,000 employees, and I've never bought the idea that big companies have smooth transitions. It can be as challenging as any. Carlyle Group is roughly 1,900 people. One of the great challenges we've seen in smaller projects, hedge funds, alternative investment, private equity, venture capital, is a generational shift. What's your best practice on that? What's the best practice to say, I want to move on and do this, your exceptional philanthropy to the American people and our history. How do you make a generational shift?
There's no perfect model. Each of the firms have gone through it in different ways. I think a good thing to do is to have somebody who's been at a firm for a long time, part of the culture. They know the ethos of the organization, and gradually they come in and take over control, and the founders step back. But it's more complicated than a typical situation. So let's suppose you're Lou Gerstner, you're the CEO of IBM,
right,
and you retire. When you retire, you don't own 20 or 30% of the company still, and you're not still, a major investor in the funds. It's a different situation. You're not a founder. So all the founders of the large private equity firms are still involved, largely with some exceptions, still involved in as owners, investment committee members,
right,
and as big shareholders. And it's a little different than the Lou Gerstner situation or Jack Welch situation when they retire and they don't really control the company through the ownership of large shares in the company.
Thanks for those comments. David Rubenstein here, of course, continuing the Bloomberg coverage of what we see in all of these different firms as they make generational moves. Mr. Rubenstein with the full interview of Lucid Group's chairman, Andrew Liveris. That's tonight at 9 p.m. In New York. Kaylee, I look at where we are in the retail sales, and I'm sorry, it's a resilient America.
Yeah, when you factor in the price of gas at the pump coming down, Tom, that really is what is borne out because it was unchanged on the headline month on month. But when you X out auto and gas, up more than expected, the control group up more than expected, and really just energy prices is the theme of the day because it is working here in the United States with prices at the pump coming down for the American consumer. Over in the UK, factor in higher energy prices, and you're looking at a 10.1% print on inflation this morning. And you see the move in the gilt market as a result of 24 basis points on the 2 year.
I'm not going to mince words, Kaylee. I think the double-digit print in Spain was one thing, but a G7 nation with a double-digit print changes the dialogue at Jackson Hole. Let's remember that's an international meeting and not just about Jerome Powell.
Yeah, I wonder who has the easier seat right now, Jerome Powell at the Federal Reserve or Andrew Bailey at the BOE, considering the market now expects 200 basis points of hikes by May. Wow. Not quite the pricing we see for the Federal Reserve. That has come down since the July meeting. How much is Jerome Powell going to have to push back on that? And do we get some insight into that in the Fed Minutes at 2 p.m. Eastern today?
And further curve inversion here, or inversion, I should say, over the last 48 hours, we come down to negative 46 basis points. deemed unimaginable really 2, 3, 4 weeks ago. And there we are, maybe to come down further inversion through that negative 49 basis point level. Futures at negative 37. Dow futures deteriorate negative 218 with the VIX really not showing much yet, 20.48 off the 19 level. A little bit of angst in the market. Don't want to oversell that. Dollar resiliency, and we saw that. Off better than good retail sales. Please stay with us on Bloomberg Television and Bloomberg Radio.
Welcome back to another Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Jamie Maggio. Cincinnati said goodbye to a tennis legend as Serena Williams went down to the reigning U.S. Open champion Emma Raducanu. Williams recently announced that she'll retire from tennis after the upcoming U.S. Open. Despite the loss, fans in Cincy gave the 23-time major winner a standing ovation as she left the court.
To be honest, I was nervous from the first point to the last point because I know what a champion she is. She can come back from any situation. So I really had to stay focused. And yeah, I'm just so pleased that I managed to keep my composure.
Raducanu moves on to face two-time Aussie Open winner Victoria Azarenka in round 2. And don't forget Tennis Channel's daily live coverage from Cincy starts at 11 a.m. Eastern. I'm Jamie Maggio.